Financial security and interdependence are like three-legged stool, resting on saving, insurance and investments. Good morning to one and all present here. On behalf of Lal Bahadur Shastri Institute of Management, Delhi, I, Soumya Jain, along with Akshi, first-year PGDM students, would like to welcome you all to this year's National Finance Conference. Financial space in India is coming of age and has evolved significantly over the last 30 years, especially since the economic reforms were unleashed. These reforms have had a deep impact on the Indian financial services sector and has ensured that the new emerging phase of the Indian financial sector will culminate in a strong, transparent, and resilient system. Keeping this in mind, we have set the theme for this year's National Finance Conference as the changing face of Indian financial markets, roadmap for the new decade. This conference could not have been possible without the august presence of all the esteemed dignitaries. I would hence like to take this opportunity to thank you all for being a part of this national conference. Before we start off with the conference, let us take a moment to remember the man whose dreams and aspirations motivated others to work towards the common goal of the nation. The man whose basic idea of governance was to hold the society together so that it can develop as a whole and march towards the common goal. The man of the masses and India's great son, late Shri Lal Bahadur Shastri Ji. Now, we will have a short film on the life and times of Shastri Ji.
मई 1964 पंडित जवाहरलाल नेहरू का निधन हो गया। देश गहरे विषाद में डूब गया। सभी के मन में एक ही सवाल था, कौन बनेंगे नए प्रधानमंत्री, कौन करेंगे इस महान सभ्यता का नेतृत्व।
आफ्टर नेहरू के बाद कौन होगा, तो ये उनको इस बात का एहसास था। जब मुझसे पूछा गया कि इस कमी को दूर कैसे करेंगे, तो उन्होंने कहा कि पंडित जी ने अपने व्यक्तित्व की वजह से, टावरिंग पर्सनैलिटी की वजह से उन्होंने इस पद को शक्ति प्रदान की और मैं प्रयास करूंगा इस पद से शक्ति प्राप्त करने की, जिससे कि मैं देश की सेवा कर सकूं।
2 अक्टूबर 1904 के दिन काशी के पास मुगल सराय में जन्मे लाल बहादुर का पूरा व्यक्तित्व ही गांधीवाद का जीता जागता स्वरूप था।
उनकी सादगी, पहली बात तो धोती पहनते थे। ये आम आदमी को उससे बड़ा भरोसा हो जाता था कि हमारे जैसे है।
पिता की छत्र छाया बचपन में ही छिन गई थी। विधवा मां के साथ ननिहाल चले गए, वहीं पर परवरिश हुई। 1921 में जब स्वतंत्रता आंदोलन में कूद पड़े तो निष्ठा और दृढ़ता के प्रमाण मिलते चले गए। 17 वर्ष की आयु से स्वाधीनता तक लगभग 9 साल जेल में काटे। रहीमन हीरा कब कहे लाख टका मेरो मोल। पार्टी कार्य में उनकी निष्ठा से प्रभावित होकर नेहरू ने लाल बहादुर शास्त्री को रेल मंत्री नियुक्त किया, परंतु 1953 में घटी एक रेल दुर्घटना की नैतिक जिम्मेदारी लेते हुए शास्त्री जी ने मंत्रालय से इस्तीफा दे दिया।
उन्होंने वो इस्तीफा देकर राजनीति में नए मूल्यों की स्थापना की।
नेहरू जी के मंत्रिमंडल में कई विशिष्ट पदों पर अपनी छाप छोड़ते हुए वे गृह मंत्री नियुक्त हुए। 9 जून 1964 पंडित नेहरू के निधन के बाद स्वयं पंडित नेहरू के चहेते लाल बहादुर शास्त्री ने भारत के दूसरे प्रधानमंत्री का पदभार संभाला। कुल 4 शब्दों में उस मृदुभाषी व्यक्ति ने देश को एक नारा दिया, जय जवान जय किसान।
उन्होंने उस समय
इस बात का एहसास कर लिया था। देश के अंदर हमें अपने जो भंडार हैं अनाज के उन्हें पूरा भर देना है और एक जो भारत के गौरव और गरिमा को देश विश्व में खड़ा कर देना है, वो अगर संभव है तो जवानों और किसानों की जय जयकार करने से ही है।
लाल बहादुर शास्त्री, Prime Minister of India, speaking on Independence Day in 1965.
हम हथियारों का जवाब हथियारों से दें।
5 सितंबर 1965 पाकिस्तान ने भारत के खिलाफ खुली जंग का ऐलान कर दिया। जवाब में भारतीय सेना पंजाब से सीमा पार कर गई। जब तक संयुक्त राष्ट्र की पहल पर युद्ध विराम हुआ, तब तक भारत की सेनाएं पाकिस्तानी सेना पर हावी हो चुकी थी।
वो किसी के दबाव में आने वाले व्यक्ति नहीं थे। जब ऐसी घटना होती है तो बहुत ज्यादा अंतर्राष्ट्रीय दबाव होते हैं। अगर आप दब गए तो झुक जाएंगे, वो नहीं दबे। लेकिन फिर शायद दोनों देशों की भलाई सोचकर वो युद्ध विराम पर राजी हो गए।
10 जनवरी 1966 ताशकंद। जिन आदर्शों के नैतिक बल का मजा वो पाकिस्तान को चखा चुके थे, आज उन्हीं आदर्शों की उदारता से उन्होंने समझौते के कागजात पर दस्तखत कर दिए। लेकिन अभी समझौते के दस्तावेज पर स्याही सूखी भी न थी कि उसी रात शास्त्री जी को दिल का दौरा पड़ा और उनकी मृत्यु हो गई। गांधी जी ने कहा था कि शत्रु का दिल जीतना ही वास्तविक जीत है। सुदूर ताशकंद में जब स्वर्गीय लाल बहादुर शास्त्री को कोसिजिन के साथ साथ खुद जनरल अयूब खान ने कंधा दिया, तो लगा जैसे शास्त्री जी बापू के फलसफे को चरितार्थ कर दुनिया से रुखसत हो गए थे। लाल बहादुर शास्त्री केवल 18 महीनों तक भारत के प्रधानमंत्री रहे, लेकिन अपने प्रधानमंत्रित्व के छोटे से कार्यकाल में शास्त्री जी ने भारत के हर नागरिक के कानों में आत्मसम्मान और आत्मबल का मंत्र फूंक दिया था। अपने व्यक्तित्व से उन्होंने निष्काम कर्म और पुरुषार्थ की वो मिसाल कायम की कि उनकी गिनती भारतीय इतिहास के सर्वोच्च महापुरुषों में होती है।
We are fortunate to have leaders and eminent personalities from the finance area with us today. We have the august presence of our chief guest, Mr. Vidhu Shekhar, Country Head India, CFA Institute, and our keynote speaker, Dr. Sandeep Srivastava, Partner, Financial Services, Risk and Regulations, PricewaterhouseCoopers, Middle East. We're also pleased to have our panelists, Ms. Rosie Mary K. Abraham, Director, Financial Markets Division, Department of Economic Affairs, Ministry of Finance, Government of India, Mr. Vijay Sardana, Advisory Committee, Professor Madhu Vij, Professor of Finance, Faculty of Management Studies, University of Delhi, Professor D.K. Malhotra, Professor of Finance, Thomas Jefferson University, Philadelphia, USA, and Mr. Naveen Gupta, Zonal Head, ICICI Bank Limited, and the panel moderator for today will be Professor Anil Kanungo, Professor of Economics, LBSIM. We're also joined by the Chair for Paper Presentation Session, Professor Vinay Datta, Professor of Finance, Ford School of Management, and Dr. Gautam Negi, Associate Professor, Finance, LBSIM. Thank you all for being a part of today's conference. Moving on, following the tradition of LBSIM, we would like our esteemed guests, Professor Praveen Gupta, Director, Lal Bahadur Shastri Institute of Management, Delhi, Professor G.L. Sharma, Head, New Projects, Advisory, Corporate Interface, Lal Bahadur Shastri Institute of Management, Delhi, Dr. Pankaj Varshney, Conference Co-Convener, Colonel Ajay Sood, CAO, and Mr. Yash Khanna, President, Management Grid, to kindly come up on the dais, light the ceremonial lamp, and offer floral tributes to late Sri Lal Bahadur Shastri Ji. Please, everyone.
शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः शत्रुबुद्धिविनाशाय दीपज्योतिर्नमोऽस्तुते दीपज्योतिर्नमोऽस्तुते शुभं कुरु त्वं कल्याणम्
Now, I request everyone to rise for the Institute's anthem.
शिक्षा ही आधार LBSIM करती है सतत इसे साकार जीवन और प्रबंधन काले करके अक्षय ज्ञान छात्र यहाँ के नित्य बढ़ाते मातृभूमि का मान शास्त्री जी के ही सारे आदर्श हमारे प्राण
May I now request everyone to please be seated. Thank you. We are honored to have the august presence of our director, Professor Praveen Gupta. I would now request you to officially set today's conference open. Please, sir.
Respected Chairman, Board of Governors, LBSIM, Shri Anil Shastri ji. Chief guest for today's conference, Shri Vidushekhar ji. Keynote speaker for inaugural session, Dr. Sandeep Srivastav ji. Dr. G.L. Sharma ji, Advisor Corporate Interface, LBSIM. And Dr. Pankaj Varshne, Conference Convener for today's conference. And Mr. Yash Khanna, President, Management Grid. Distinguished speakers of the panel discussion, session chair, delegates, faculty colleagues, Chief Administrative Officer, Colonel Ajay Sood, students, ladies and gentlemen. Good morning to all, and I extend a warm welcome to each one of you on E-National Finance Conference 2020, organized by Lal Bahadur Shastri Institute of Management, Delhi. Globally, financial markets have been experiencing considerable volatility due to pandemic situation, which is nearly for 1 year now. There are risk-averse sentiments across the globe, and it has its own ramifications on financial markets in India. There has been a coordinated policy action to mitigate a broader fallout to economic activity, and it has boosted market sentiment today. The regulators are monitoring global and domestic developments very closely. They are ready to take appropriate actions to ensure disciplined functioning of financial markets, maintain market confidence, and preserve financial stability. India today is one of the most vibrant global economies. The relaxation of foreign investment rules has received a very positive response from insurance sector and many other sectors. The Association of Mutual Funds in India is targeting nearly five-fold growth in AUM to nearly US $1.5 trillion and more than 3 times growth in investor accounts to 130 million by 2025. India's mobile wallet industry is estimated to grow at a CAGR of 150% to reach US $4.4 billion by 2022. While the mobile wallet transactions may touch around US $500 billion during the same period. The objective of the conference is to deliberate on the critical issues faced by Indian financial sector in the times when the country's financial sector is undergoing a structural shift and with a greater role played by non-bank intermediaries and higher recourse to market funding by the corporates. The conference shall cover topics related to recent developments in Indian financial system and the challenges pertaining to regulations, reforms, instruments, and the increasing role of technology that is expected to come in the new decade. The impact of disruptions like COVID-19 pandemic may also be discussed during the panel discussion. So I extend once again a very warm welcome to each one of you, and I expect a very healthy and fruitful discussion during the day. Thank you so much.
Thank you so much, sir. Now, I would request Dr. Varshne, conference convener, to apprise us about the theme of the conference. Please, sir.
Good morning, everybody. Chairman, LBSIM Board of Governors, Dr. Praveen Gupta, Director, LBSIM, Dr. G.L. Sharma, Advisor Interface, Corporate Interface and New Projects, Mr. Vidushekhar, who's joining us from Bombay, Chief Guest for the conference, and Dr. Sandeep Srivastav, Partner, PricewaterhouseCoopers, members of the panel for the panel discussion, faculty colleagues, participants, delegates, dear students, and all the viewers on the watching on the internet. On behalf of LBSIM and on my own behalf, I welcome each one of you for sparing your time and being part of this finance conference today, which was originally planned for March, but was postponed because of the COVID. And it's my privilege to introduce the theme for the conference today, the changing face of Indian financial markets roadmap for the new decade. As we stand in this year 2020 and reflecting back over the decades, we can proudly say that our financial markets have come a very long way forward. Yet there are areas which need some reflection. The oldest stock market in Asia, the Bombay Stock Exchange, or it's now called the BSE Limited, started over in 1875 under a tree with an open outcry system. It has now transformed into a fully computerized and automated trading platform, thanks largely to its competitor, the NSE, which has now become its major competitor and its big brother now. Today, both NSE and BSE are modern exchanges and comparable to the best in the world. Yet we find that the trading is largely concentrated in a handful of stocks, although over 4,000 scripts are listed on these exchanges. Talking about the new issues market, it used to take months before investors could come to know if shares have been allotted to him or not, and much longer to get the physical copy of physical share certificates and refund orders. But now it's just a few days he gets to know the result, and that too without blocking his funds, thanks to ASBA. From the days of CCI, when equity shares were priced based on a set formula, which was called the CCI formula, which only few people knew about it, was decided by people sitting in the North Block, to a system current now where the investors bid for equity shares at different prices within a particular price band, in an effort in a process to discover the price of the equity share, what fair price should it be. Yet we find IPOs being hugely oversubscribed, which was the situation in the CCI era also. We recollect issues of Tata Timken and International Travel House as the last examples of the CCI era. And which is comparable to the most recent example of Mrs. Bector's food specialty, which was oversubscribed over 200 times. Starting from just one mutual fund in 1964, the state-owned Unit Trust of India, and running just one scheme for many years, we now have over 40 AMCs, both Indian Indian state-owned, private, and foreign, managing over 2,000 different schemes. Yet we find savings through mutual funds in India at an abyssal low of about 3% only of the total savings going into mutual funds. Deposits and gold and real estate being the prime venues where people like to invest, we Indians like to invest. AMU to GDP ratio for India is about 10%, while the global average is about 55%, and in some countries even more. It is slightly higher than 55%. Both indicate the lack of penetration by the mutual funds. So how can the mutual fund be made popular and improve the penetration? What are the products may be offered which suit the requirements of the Indian retail investor? That is a big question. Going back, gone are the days of the Badla system, which was supposedly an indigenously developed risk management tool, but was inherently a speculative instrument. We now have the cash and the futures and options as two different segments on the exchanges, which match global standards. Again, we find that the trading is limited to a few products only. Index derivatives and Bank Nifty Index seems to be more popular with the investors. Interest rate derivatives find few takers, even in its third avatar. Commodity derivatives are often accused of as the reason for the spike in the commodity market by the lawmakers, and very promptly a ban is imposed. And now the RBI has rigged in the issue of corporate governance and ownership in its recent internal report. How far would it be advisable for large corporates to be owners of banks, especially when banks are facing the issue of NPAs, thanks to loan melas sponsored and legitimized by the state and crony capitalism? How can the system get rid of this mess? What are the options available to the central bank or the government? Is privatization of public sector banks a possible solution, as suggested by the secretary the other day? Mis-selling of insurance products is still rampant. NBFCs play an important role in financing of corporate and retail sector, but are also not untouched by the menace of NPAs. ILFS and DHFL are still fresh in our minds. The role of credit rating agencies is under big question mark globally. Then there are issues of algo trading, cryptocurrencies, and so on. In all this, I think the role of the regulators, all put together, Reserve Bank of India, SEBI, IRDA, PFRDA, would become very important in framing rules and regulations which are in sync with the global best practices and also suited to the Indian situations and requirements. These are some of the issues which we hope would be discussed during the course of the deliberations today, and we hope that to have some useful and concrete suggestions coming out forward, which may put forward to the policymakers. With these words, I once again welcome all the speakers and participants to this conference. Thank you.
Thank you so much, sir, for appraising us with the theme of the conference today. We're all looking forward to the enriching discussion lined up. Taking the proceedings forward, we would now like to introduce our chief guest for today, Mr. Vidhu Shekhar. Mr. Shekhar is the country head at CFA Institute, India. He is responsible for advancing the mission of CFA Institute and supporting CFA charter holders across India. With over 3 decades of national and international experience, Mr. Shekhar is a seasoned financial and investment professional. He is a member of Primary Market Advisor Committee, SEBI. Prior to this, he was the Vice President, New Products and Business Excellence, National Stock Exchange of India, overseeing a product initiative in debt and equity markets. Mr. Shekhar has also contributed to the development of Indian financial markets through his participation in the work of various committees, including the Dr. Patil Committee on Corporate Bonds and Securitization and Raghuram Rajan Committee on Financial Sector Reforms. Mr. Shekhar will be joining us from Bombay. Sir, we're extremely honored to have you here with us today. I would now request you to kindly deliver the inaugural address. Please, sir.
Thank you so much. Are you able to hear me?
Yes, sir, you're audible.
Thank you so much. This is the first time that I am participating in a hybrid conference with people physically participating and I sitting in my bedroom. So, it's a sign of changing times, and I'm really honored and grateful that you would consider inviting me to inaugurate this conference. Thank you to Professor Praveen Gupta, Director, Dr. Pankaj Varshney, and the other members on the dais, as well as Dr. Sandeep Srivastava from PwC. It's a very interesting topic that you have chosen, and coming from the CFA Institute, where we have one foot firmly planted in academics and the other one in practice, I think this is a wonderful topic for us to discuss, because all of you are familiar with what we do in terms of the credential, the CFA credential. But I must tell you that as a membership organization, global membership organization of over 170,000 members spread all over the world, we work very closely with policymakers, regulators, and others in order to promote best practices, promote market integrity and governance, and so on through our various research, outreach, and policy initiatives. And when we do this, we need to keep a close eye on what is happening, try and understand what's happening around the world. And we do this through our members. In India, we have a India local society called the Safer Society India. And the society members are passionate volunteers and they participate in all these things. I myself was for several years a volunteer with the society, and I was a vice president of the Safer Society India before I was offered the job of running the India office, which the institute opened back in 2014. And since then, I've been doing this work. So, and before, as I was introduced, my previous job was at the National Stock Exchange. So I've had a sort of a good place in the market to watch what's been happening, and I'm happy that we have made so much progress in the last decade. So today, we have an interesting title: "The Changing Face of Indian Financial Markets: Roadmap for the New Decade." Right, and we are conscious of the fact that we've been through a very challenging year, and we are entering into a new decade with so much uncertainty. Saying anything about what is going to happen in the next decade is an endeavor fraught with danger. As the Chinese poet Lao Tzu once said, "Those who have knowledge don't predict, and those who predict don't have knowledge." In any case, you have a great panel of bureaucrats and bankers coming up later in the conference, so I'm going to leave the crystal ball gazing to them. Instead, I will focus my remarks on a few trends that I think will shape how the markets could evolve in the next decade, and suggest ways about how these trends will shape a necessarily uncertain future. But before I get into my argument, allow me to take a moment to set up the context. The title seems to suggest that a roadmap exists and all we have to do is to read that map. But that's not true. I grew up in Delhi, and while I was growing up as a kid, my parents would occasionally take me to the zoo. And that's where I first encountered a map that I could use. So there would be these large maps with a sign which said, "You are here." And it told me as a child that, oh yes, I came through this particular route and I saw the monkeys and I saw the birds, and if I turn right and go this way, I'll be able to see the tiger. But unfortunately, real life is not like that, and we do not have a roadmap that we can see in the zoo. Even if there is no map, there is some expectation that we can say something useful about how things are going to happen. Now, if the way history unfolds is based on contingent factors, historians have always argued whether historical development is driven by structural factors or by random events. A common example that is cited is the way World War I unfolded in 1914. It was the chance assassination of Archduke Franz Ferdinand that triggered a chain of events that led to the war and shaped the rest of 20th century. But the arrangements that led to the war had been in place for some time before the war broke out. Similarly, I would like to cite Francis Fukuyama's famous work, The End of History, which was written in the 90s after the collapse of Soviet Union. It seemed to us at that time that the competition between communism and liberalism was over, and the history of the way financial markets and the economies around the world will unfold will be in a direction of liberal democracy. But that's not how it turned out. With all these caveats, let me make an attempt at the topic itself. But before I dig in, 2 points. First, when we think of financial markets, it is important to understand that markets exist within the context of the underlying economic arrangements and institutions. These arrangements are both domestic and international, and they change over time. Changes to markets are driven by changes in the economic environment. Sometimes these changes are slow and steady, but from time to time, they can be sudden. Shocks and crises often arise from shocks that come from outside or within, as we have seen during this year. I like to think of three major interacting drivers of change in financial markets: technology, regulation, and competition. All three drive the actions of institutions in ways that lead to change over time. Let's take a look at each in turn. With recent developments in machine learning and artificial intelligence and our ability to process large amounts of unstructured data, technology is being used in all areas of finance. Digital transformation and strategic use of technology has become critical to competitiveness. Within the investment decision-making process, analysts are now using new sources of data and large unstructured data sets to improve their decision-making. Availability of satellite data as well as natural language processing has given more tools to analysts and changed the way analyst teams work. Advances in computing have made it possible to use new quantitative techniques that change how portfolios are managed. A good example is the rise of smart beta products. These are typically exchange-traded funds that use automated methods for implementing certain investment styles, providing customers with the ability to get the benefits of active investing without associated costs. A third source of change is trading technology. Already in the last 10 years, exchanges and other trade platforms have reduced latency in some cases to below 1 millisecond. Algorithmic trading has co-evolved with the evolution of trading platforms, creating new opportunities as well as risks. These changes will accelerate in the next decade, and I expect AI to become mainstream. CFA Institute recently published a report called AI Pioneers, where we looked at some of the early work of how artificial intelligence is being used by investment teams. We are now working on a how-to guide in which we give advice to specific aspects of investment management process where artificial intelligence is being used. I'm expecting that some of these changes are going to become mainstream, and that will provide an opportunity to the students here who pick up some of these skills to advance in their career and to disrupt the way the industry works. The second area that I would like to highlight is regulation. It is a complex subject, and we don't have the time to discuss it properly here. Regulatory change determines the products offered by institutions, the choices available to investors, liquidity in markets, and many other outcomes. Regulatory changes are often driven by scams and market failures, with regulators playing catch-up. They are also shaped by agencies like IOSCO and OECD, as well as standards bodies like International Accounting Standards Board and Sustainability Accounting Standards Board. We can pick up some of these issues surrounding regulations in our interactive session. Finally, in conclusion, I would like to highlight a few changes that I see becoming more important in the next decade. The first is the growing importance of private markets and alternative assets. This is already the case in India, where AIFs have become more and more important in the last few years. Traditional asset allocation of institutional investors has favored publicly traded stocks and bonds. However, this has been changing over the years, with allocations to private equity, hedge funds, commodities, and other assets increasing their share of institutional asset owners' portfolio. India has been slow to catch up on this because our pension funds and insurance companies are still not allowed to invest in alternatives. Reforms in pensions and insurance can drive allocation to alternatives, but this will come with its own governance challenges. The second trend that I would like to point out is the trend towards sustainable investing. The growing importance of ESG factors is pushing companies towards better disclosures and reporting. The push from investors is making boards pay more attention to the environmental impact of their actions and to take environmental and social factors into consideration while developing and executing their strategy. Companies and boards have to become much more responsive to investor and other stakeholder concerns about sustainability. A third important trend that we must pay attention to in the context of India is the increasing importance of domestic flows vis-a-vis foreign flows. For many years, the performance of Nifty was dependent on FII flows. This has changed in the last few years. Even when FII flows reverse, domestic flows have kept the markets up. We are currently in a very benign environment where global liquidity is propping up emerging markets. This, combined with easy monetary conditions because of RBI's accommodative stance, has created a benign environment for stocks and bonds. However, these conditions will reverse at some point, and depth in our domestic investors would be an important buffer to the reversal in FII flows. Finally, a word about institutional and market reforms. Over the last 30 years, India has slowly and haltingly moved from a state-led economy to a market-led economy. We still have a long way to go on this path, as the financial system is still dominated by the state. In their books published recently, ex-RBI Governor Urjit Patel and ex-Deputy Governor Viralacharya have talked about the idea of fiscal dominance as the theory of everything governing the Indian financial system. The two books describe a system where the government uses banks as an instrument of policy, both as buyers of government bonds as well as for directed lending. This results in the crowding out of private sector borrowings and creates all kinds of conflicts between the government's needs to manage its fiscal deficit, the risk on bank balance sheets, and movements in interest rate markets. Reforms that take away these conflicts can play an important role in the evolution of financial markets in India. If we are able to make the institutional and governance changes in these areas, we can see change not only in the way financial markets function in India, but also the long-term growth potential of the country. With these words, I conclude my remarks and open it up to questions. Thank you.
Thank you, sir, for presenting and sharing such insightful views on the topic. The floor is now open for questions. I would like to hand over to Mr. Sauramya Bhatnagar to moderate the question and answer session. Please, Sauramya.
Good morning, sir. First of all, I would like to compliment very excellent points quoted, very well figures quoted. So, sir, I would like to ask the first question which I would like to ask is, what steps can the financial sector take to attract overall savings in the Indian economy?
So it's a complex question, and the steps to be taken are by many different types of stakeholders. Okay, so we already can see that, for instance, the mutual fund industry runs a very significant major campaign called Mutual Fund Sahi Hai, and that has resulted in significant flows into mutual funds over the past few years. But sorry. There is a I would think that there is a need for us to both educate the final investor, because we have this issue that people come into the market, people start investing without really understanding what they are getting into, and then they get their fingers burned. Hello, can you hear me?
Yes, sir. You are loud and clear.
Yeah. Right. So and then they disappear. So we don't get the kind of allocations in savers portfolios to market related assets as we would like to. So that is one thing. I think investor education is very, very important. I'm also expecting, I didn't cover this in my remarks, but I'm also expecting technology to play a role in helping investment advisors, and also new products like ETFs, etc., to become an important part of people's portfolios. So there will be product development effort, there will be regulatory changes, there will be education, And so all these things will combine together to drive growth in financial savings in India. It's an important aspect for us, even from a policy point of view, because in India the dis-savings of the government plus the corporate sector is higher than the savings of the Indian household sector, and in the long term, this impacts the macroeconomic stability of India and makes us vulnerable to the ebbs and flow of global liquidity. So this is a very important issue that you have raised, and I think we should do some more work in order to identify the various areas where progress has to be made.
Okay, sir. So, sir, the next question which I would like to ask is that how do you see the current market validation of companies, valuation of companies when the equity market is expected to have more severe downside risk?
Right. So I will go back to my original quote from Lao Tse that you should not make predictions. It's clear to anybody who is looking that the valuations that we are currently seeing is because of liquidity in the market, and it's hard to say. It looks at this point in time that these easy liquidity conditions will persist, for the immediate future and are unlikely to reverse. But at some point they will. In any case, if you ask about valuations, what we have seen is that post the pandemic, the stronger companies have become stronger. So there has been, so you can expect that there will be consolidations and leaders will become stronger. There will be a lot of deal-making activity, M&A, and so on and so forth, which are all good, for the equity markets. But at the same time, a liquidity-based run of the market is always worrying in the longer term, and it's hard to say when these conditions are going to reverse. We can go back to what happened post the global financial crisis in 2008, 2009, when again we had a lot of liquidity-based rise in the markets. But then when the taper tantrum hit in 2013, we suddenly found ourselves in great difficulties when that kind of liquidity reversed.
Okay, sir. Thank you very much for the answer. This answers well. This clears almost all the doubts. So, sir, the next question which I would like to ask is, of all the countries in the world, the disconnect between the rallying global stocks and the deteriorating data is probably most pronounced in India. And the nation's share has logged one of the best rebounds from March lows globally, while battling worst economic data. So, sir, why this conundrum and possible reasons for the disconnect between the equity markets and economy?
So as I just said, just before this, the liquidity conditions are responsible for some of this. But also, I think we must remember that the pandemic has actually hit the smaller firms much more than the larger firms. The larger firms have been able to, because they have been able to access the bond market or access other sources of capital to rapidly, raise capital and create a war chest for whatever they want to do. And the pandemic has actually impacted, individuals and small firms much more than it has the larger firms. We should be careful of the fact that if the scarring because of the pandemic is so much, we don't know yet, what the eventual effects are going to be. That the demand on which large firms depend will have a longer term impact. Then some of these valuations will have to start coming off. So I don't have any fresh insights beyond what I have already told you. Some of these valuations are liquidity driven. I don't know whether India performs worse than other markets because a lot of markets are doing quite well right now, and it's going to take us time to see, how much of an overreaction is there.
Okay, sir. So, sir, on the behalf of students, I would like to close the question around with the last question. That what is your view on the impact of burgeoning debt and expanding fiscal deficit of the global economy on the stability of financial markets 5 years down the line? And what would be the key learnings which regulators and central bankers can take forward from 2020?
Yeah, so this is a question which is very hard to answer. We have seen, that low interest rates, very low, that lower for longer, low interest rates for a very long time, negative interest rates. So much of the issued bonds right now are trading at negative interest rates. These are going to have long-term impacts. There is really no meeting of minds or no consensus on what the long-term impact is going to be, whether but as far as emerging markets are concerned, I think that it is only a matter of time. Like I said, right now conditions are benign, but eventually when the conditions turn, then it's going to result in a withdrawal of liquidity, which will impact all our markets. And it's not just equity, but also bonds, borrowings and things like that. And for investors who are doing long-term asset allocation, for instance, if you're a fund manager, you're in a happy situation right now because everything is fine. But if you're an investor who has to think of the next 10 years, or you're going to retire in 15 years, then you need to be mindful of your asset allocation decisions. In fact, I don't know whether we have any easy answers for how to deal with this conundrum. So yeah, I mean, it's a complicated question to answer. If you look at US and Euro, they are, so for instance, these are some markets which are safe haven markets. They have deep bond markets. They have to fear less with this flush of liquidity for a long period of time, unlike markets like ours, which are really not safe haven markets with mature institutions.
Okay, sir, thank you so much for your time. Thank you so much for the answers. I think we are closing the questionnaire round from here, and we can take this forward.
Thank you, Sauramya.
Thank you, sir. Thank you, Sauramya. Now, I would request Dr. G.L. Sharma to felicitate Mr. Shekhar with a memento.
Thank you, Mr. Sharma. I hope to be able to come to your institute in the near future.
Thank you, sir. Moving further, I would now like to take this opportunity to introduce our keynote speaker for the day, Dr. Sandeep Srivastava. Dr. Sandeep Srivastava is a partner, financial services risk and regulation leader at PricewaterhouseCoopers, Middle East. A specialist in treasury and global markets for bank and asset management companies, Dr. Srivastava has over 2 decades of experience in risk management and regulations, including capital adequacy, liquidity, and macroprudential regulations. With a PhD in finance from IIT Delhi, Dr. Srivastava has worked with KPMG for almost 9 years as a financial risk management consultant. Thereafter, as a partner in EY USA for almost 9 years. Sir, it is an honor to have you here with us today. I now welcome you to the Finance Conference to deliver the keynote address. Please, sir. Sir, you are on mute. Kindly please unmute yourself. Sir, you're not audible. Sir, you're still not audible.
Am I audible now?
Yes, sir, you are.
Yeah, good morning, everyone. First of all, I wish to take this opportunity to convey my sincere thanks. Sorry, my voice is echoing. I am not too sure whether you are able to hear it. Are you able to hear me now?
Yes, sir, it's clear.
Are you able to hear me?
Yes, sir.
Okay. Okay. First of all, I wish to convey my sincere thanks to the Institute to invite me. And thank you, young lady, for the kind introduction. I would really appreciate also to add one more thing, that I started my career as a faculty member at LBSIM, and I worked for 9 years, and still carry those fond memories. So once again, thank you very much for inviting me to this. My sincere thanks to Mr. Chairman, Mr. Anil Shastri, Dr. Praveen Gupta, our beloved Dr. G.L. Sharma. And it was nice to see you once again. The only change that I see, Dr. Sharma, is the mask that you are wearing right now. But other than that, you are pretty much the same. So thank you. Thank you very much for taking off the mask. But you can have it again because this is the time of social distancing. But good to see you again. Thank you, Dr. Vashne, Mr. Vidhu Shekhar, Mr. President, Management Grid, other dignitaries, and my dear students. I think, this subject is very topical and dear to my heart. And although it is sometimes difficult to predict about the future, but fortunately or unfortunately, this is the way we work. While Mr. Vidhu Shekhar has set the tone for this discussion, I will get into some specific areas. And if I'm honest, I must confess one thing. I may not be having the full insight about the Indian market. What I will do is I will start with the global perspective and then zero in on some specific areas relating to the Indian market. Now, the first thing that I would like to, when we talk about the changing face of financial markets, and if I take you back to March beginning, there was a huge disruption. And if I'm honest, no one had a clue around how it is going to unfold. And despite the fact that, while we are working in some of the global organizations, some of the big organizations, if I look at what was the level of preparedness, I don't know what is the right answer, but certainly there was a lot of nervousness. There was a lot of anxiety around what is going to happen. And I'm sure you would have seen how the financial markets behaved at that point in time. So, all in all, while it is difficult to look at the changing face and predict what is going to happen in the next decade, one thing is extremely certain, and that is that this financial market is going to undergo significant changes. And I'll touch upon the different areas in which there are going to be significant changes. And I'll touch upon 7 themes here. Theme number 1 is that whether you like it or not, the financial market is going to become more complex. And when I say more complex, what is going to happen is that you would see that Indian market is going to become more interconnected with what is happening globally. Right now also, those who are researching, I am perhaps not at that stage right now, but those who are doing their research, one would clearly see the happenings in global market are significantly impacting the way Indian market plays, whether you are talking about stock market or you are talking about bond market, you're talking about insurance sector. So this interconnectedness that has developed over a period of time, what you would see is it would lead to a lot of complexity as far as the Indian market is concerned. And through the complexity, what is extremely important is that the investors, specifically the retail investors, they play cautiously in the market. Because as Mr. Shekhar pointed out rightly, that the current rally in the market that we see is liquidity-driven rally. And whenever there is a liquidity-driven rally, let us be prepared for extreme fluctuations in the market. And these extreme fluctuations, if I look at the history, and I think one of the authors, he has articulated it very well as Kindleberger in his book called Panics, Manias and Crashes. The worst hit segment is the individual small investor segment. So one thing which I would say is that while this complexity is increasing, it is extremely important for the small investor to remain cautious. When it comes to institutions, and when I say institutions, what I mean by institutions is financial services institutions and corporate sector. The institutions, they need to remain on guard in terms of how they are going to protect against the interest rate fluctuations, how they are going to protect themselves against the foreign exchange fluctuation. So they need to be on guard all the time. So this is what is the fun of being interconnected globally. And given a choice, what I would do is I would take all the good elements of interconnectedness, but unfortunately, that's not the way the life works. So while, the benefits that you are getting in terms of your FDIs, your FII flows, and being connected with the global market, all those benefits you are reaping. But at the same time, all those risks are also creating, danger and threat for you. And that's why I say that there are complexities, and these complexities are going to go up significantly in the next decade. This is theme number 1. Theme number 2 that I would like to touch upon is around what is happening in the space of fintechs and the big techs. Now, I'm sure that, you guys are following what's happening internationally. One big trend that we are witnessing, which is disrupting the financial market and corporate sector in general, is around the fintechs. Now, while, we have carried out a number of studies, and my sense is that this phenomena is going to continue for the foreseeable future. If it is next decade, it is next decade. However, there are some big developments which are taking place in Europe and North America around the big techs. Because today what has happened is that the boundaries that used to be there between the financial sector and non-financial sector, those seem to be blurring. If I look at some of the developments in the payment industry, for example, with the advent of Apple Pay or Global Pay or Amazon Pay, what has happened is that some of the non-financial services players have entered into the arena of financial services. Now, when this happens, there are warning signals. One would say, oh, but this is what the technological innovation is all about. I do understand that this is the technological innovation. But at the same time, the risks that it poses to the financial system are significant. And just one example that I would like to take is that when many of these payment players have come in the market, how much oversight as a regulator the central bank is having on this, while central bank is regulating banking sector, non-banking financial institutions and all. But what happens to these big techs? Is central bank in control of what's happening in this? And the classical example of a failure that I would like to quote here is the Wirecard in Germany. The amount of payments that this company was processing on a daily basis, if you look at the sheer volume, it is mind-boggling. And that's why today what you see is starting from China, in US, Europe, they are going to tighten the noose around these big techs. So the whole objective there is that while you want to retain all the beneficial contribution that these big technology firms are making, what you need to do is you need to control some of the activities which may spiral into a big bubble. And this is where, what I see is while this phenomena is going to continue, the regulator is going to step in and look at some of the activities which these big techs have entered into more closely and regulate some aspects of it, which in my view is the requirement of the day. The third theme that I would like to touch upon is on the customer preferences. Because at the end of the day, if you look at it, a lot of this innovation is driven from an ultimate consumer perspective. And this is going to continue in the foreseeable future. I think, never before in life, I, acknowledged and realized that customer is the king. Because in essence, if you look at it, when this COVID hit in, at that point in time, what was the usage of Zoom? What was the usage of Microsoft Teams? What was the usage of Google Meet? Not that much. But as you got into the crisis, you had your requirements. All the big companies, all the big platforms, they rushed into, making sure that your requirements are fulfilled properly. And this is going to continue. What I see is nowadays a lot of digital platforms in the form of digital trading, digital banking, insurtech. There are a number of those developments that are happening. And one of the key focus areas of those developments is looking after the requirements of consumers, and especially in the countries like India and the countries that I look after in the Middle East, where the young population is growing. What we are seeing is the adoption of technology is significant. And in that, in order to cater to the needs of millennial customers, you have to change. And this will continue for financial services industry. So if I take some tangible examples, today, all your KYC processes in terms of opening an account can happen without having any physical interaction. And that's what was the requirement of consumer, because no one wanted to, go to a branch and have those interactions, or, waiting for someone to arrive from the bank and do all those formalities. So today you have video KYC in India. I understand that it has already been adopted. In many of the other countries, it is being adopted as we speak. So consumer preferences clearly are going to drive the changes in the next decade. The fourth theme that I would like to touch upon is around cybersecurity. Now, if I'm honest, and if I look back last 10 months, with a lot of us moving into remote working, are we clearly in control of what are the data breaches that are happening? What are the privacy breaches? What are happening? The answer is no, absolutely no. So while we are embracing some of the new technologies, including cloud, one area that needs to catch up significantly in the next decade is the cybersecurity. And if I give you an example, 2 weeks back, we were called into an urgent meeting, and there were around 100 people from across the globe in that meeting. And what I came to know was, without naming the firm, over the weekend, there were more than 200 attacks on the confidential information for one of the large global organizations. Can you imagine, when you are embracing the technologies like cloud and you are having your private data, confidential data on it, and if such attacks are there, this is clearly a big risk for the whole world, and especially the financial services sector and the financial markets are deeply impacted by this. So clearly what we see is that cybersecurity is going to remain in the forefront as far as the next decade is concerned. The fifth theme, and Mr. Shekhar, he touched upon that very precisely, is around the regulatory expectations. Now, while the regulator plays a catch-up game in most of the cases, if I start with the global financial crisis and look at it, most of the time what we have seen is that the industry is ahead of the regulators and regulators are playing catch-up game. In some countries, what we see is regulators are extremely conservative and to some extent they kill the innovation. All said and done, what is ideally required is a balance. Balance, on one side, you need to make sure that the financial innovation that helps customers, that helps economies in terms of efficiency, that continues. But at the same time, you need to have adequate controls around the elements which are not the desired element. You need to control the unintended outcomes because they would create a lot of risk and they would clearly compromise the integrity of financial system. And what we see is that regulators are going to be on their toes in the next decade. They will be controlling some aspects. They will be a bit lenient on the other. Whenever it comes to serving the consumers, serving the investors, I expect that regulators are going to follow stricter norms around this area. And one example in that respect is the market conduct regulations, which are gaining more and more prominence, how to treat customers fairly, because, this has become a big topic in the Western world. And what I understand is that in India, there are a number of initiatives which have been adopted in terms of consumer protection, in terms of investor protection, and those steps are going to be intensified in the next decade, given the type of risks that we are exposed to. The sixth theme that I would like to touch upon is around cryptocurrencies. And if I'm honest, then I don't want to stick my neck out too much, but still I would think that cryptocurrencies is one area wherein most of us understand only partly. We don't understand it fully. while cryptocurrencies are evolving over a period of time, and I saw just yesterday, Bitcoin has touched $23,000. Some of these trends, while they are encouraging from the perspective of that, cost of transaction is going to go down, some of those trends are certainly encouraging. But one thing I can tell you is the way the cryptocurrency fluctuates, it is mind-boggling. So if I just go back, 2 years from less than $1,000 moving up to $20,000, and I'm talking about Bitcoin here, then falling down to $3,000, and now once again at $23,000. And if I go by some of my analyst friends, what they are telling me nowadays is that $40,000 is the next stop. Now, if this is the level of fluctuation that takes place in any asset, let alone cryptocurrency, does that inspire a lot of confidence among the investors and among the masses? Not at all. It is somewhat very worrying to me. And what is more worrying to me is sometimes when people start talking about central bank digital currency, CBDC, which is currently being experimented in some of the countries. The only thing that I can say at this point in time is that in the next decade, the first half of it, I would expect a lot of skepticism around the sustainability of cryptocurrencies till the time we enter into a stage wherein we start seeing the fundamental basis for the valuation of these cryptocurrencies. Because until or unless I can see the fundamental basis for the valuation of these cryptocurrencies, I don't think I would be very encouraged in terms of taking positions, in terms of using cryptocurrencies for my day-to-day requirements. Although I do see that some of the real estate developers, they have started accepting cryptocurrency instead of the normal paper currency. All that is fine. I think from a marketing perspective, I do understand it, but I would take it with a pinch of salt at this point in time. And in the next decade to come, what I expect is next 2 to 3 years, if these cryptocurrencies, they are able to demonstrate to the market that their valuation is based on some fundamentals, it would work well. Otherwise, it would die its natural death. The last theme that I would like to touch upon is the ESG considerations that Mr. Vidhu Shekhar, he pointed out. These are around environmental, social, and governance related considerations. Now, if I'm honest, there are many good things that financial services industry has done over a period of time. But one area which they have not addressed well are the considerations around environment. Now, today, as I see, European Central Bank, they have come up with the specific regulations around how do you incorporate ESG considerations in your day-to-day working. So, for example, if I ask banks that have they been giving adequate attention to the environmental considerations when they are considering a proposal for lending, some of the banks, they have been. I would certainly accept it. But industry at large has not given due consideration to this theme. And as we progress, and as we are seeing that these environmental factors can certainly disrupt our very existence, what I would expect is in the next decade, ESG is going to become a more prominent topic, and you would see, in the first 2 to 3 years, that is, 2021 to 2023, 2024, I expect that regulators are going to push it till the time it becomes part of business as usual for the financial services sector and financial market in general. So, in short, if someone asks me a question, what is changing in the financial markets? Pretty much everything is changing in the financial market. Your consumer preferences, your delivery channels, the way you are going to transact, the way you are going to protect yourself, the way regulators are going to regulate the market, the way we are going to exchange value in terms of currencies, paper versus cryptocurrencies, everything is going to change. Is Indian market any different? As I said, I'm not an expert on Indian market, so perhaps I cannot say it authoritatively, but my hunch is that Indian market is no different. And what you are going to see is that Indian market is going to align with the global markets. Given that we are the technology hub, I would expect in the next decade, we are going to take lead in some of the financial innovation that is going to take place. And one thing I can say is that the future is bright. You have tons of opportunities that are coming your way as we progress. But with these tons of opportunities, a word of caution is that the way and the quantum in which the opportunities are coming, it is the same quantum in which the risks are also coming. So what you need to do is, whenever you are in doubt, just apply common sense. And that is the name of the game, I would say. And I stop here perhaps and hand it over back to you. Thank you.
Thank you so much, sir. The floor is open to questions. I would now like to hand over to Ms. Dipali Singh Rathore to moderate the question and answer session.
Yeah, thank you so much. So firstly, I would like to thank Sandeep sir for such an enlightening session. The wisdom that you brought forth was definitely, I as a finance student could relate to it. So very well spoken, sir. Thank you so much. So I'll be taking the Q&A session on behalf of the students and faculty members. All the questions that, as you spoke, I have received a lot of questions from all of them. And I'll just start by posting to you the first question. So here we go. So the very first question that has come for you is that a negative interest rate is a concept that is quite prevalent in global to revive the economies. So do you think that adopting negative interest rates will be viable for boosting the growth of Indian economy, and possible reasons for RBI to not consider this strategy? Over to you, sir.
Yeah, I think this is a difficult question to answer, I must say. And, it's good that you guys are asking difficult questions. Now, to me, it seems like negative interest rate environment is not a sustainable environment. Although I do understand many a times what has happened is interest rate is used as an instrument in order to hedge the real economy. But clearly, what I see is its sustainability is questionable. I do see that some countries have been able to sustain it for a longer period. I am referring to Japan here, for instance. I don't think in the context of India, negative interest rate is a sustainable proposition. And the reason I say it is, look here, we have a growing population. The demographics are changing. With social security being not that strong, what you see is people are relying on their savings for their post-retirement needs. And in such kind of an environment, if you get into an era of negative interest rate, in my view, it is going to lead to social problems. And those social problems are going to have wider ramifications for the entire economy. So, as I said, I'm not an expert on Indian economy, but because I sort of, left India almost 15 years back. And since then, my knowledge has not been growing at the rate that it should grow. But based on whatever I know about the Indian market, I don't think that, getting into negative interest rate environment is the right solution for our problems. And I do understand the public debt is increasing in India, and, the fiscal deficit is a growing concern. But despite all these challenges, I would still think that the state, the federal government should not be using interest rate as an instrument beyond an extent. They need to focus on real economy, and the real economic growth needs to happen through other initiatives, but not the interest as the primary instrument.
Thank you so much, sir. That answers the question. So moving on to the next question. So do you think a digital rupee would be a catalyst in financial inclusion? And what can be the potential challenges in adoption of digital rupee?
Yeah, you guys are asking all difficult questions. So now I think, see, if I go back historically, and if I look at the valuation of currency, we have evolved in an environment through the gold standard system. So what is of fundamental importance is that the stored value needs to have some basis. So if the digital rupee is launched, keeping in view the fundamental value that this currency can store, I think it would work very well. And as a medium of exchange of value, it should work well. The problem lies when you are not able to control the circulation of it, when you are not able to change the direction or channelize it into the right pockets. The problem lies when you are not able to connect the value, the stored value from the fundamentals. This is where the problem lies. So if you really ask me, am I bullish on digital rupee? I am bullish on digital. But what needs to happen is that this digital rupee needs to function in an environment wherein you are able to relate the value of it with the fundamentals. And the time you break this connect, then there is a problem. So while being bullish as a medium of exchange, I would be extremely cautious in terms of making sure that the sort of growth is controlled and you are able to monitor how this is moving from one part of the economy into another part of economy.
Thank you so much, sir. I definitely did gain an insight, and I'm sure the student who had posted this question also did receive a lot of insight from your answer. And as you are answering this, I have just received the next question. So here it is for you. So retail investors in India are spending millions on trading in cryptocurrency in India every day. It now has a 10-year track record and has created more returns than any other investment in the same time period. The regulatory uncertainty in India is keeping away many companies from crypto trading. So do you think that Indian markets are mature enough to legalize trading in cryptocurrencies when Bitcoin has crossed the $20,000 mark for the first time?
Yeah, this is perhaps one of my favorite questions so far. One thing I must say is that I would like to caution investors against cryptocurrency. And the reason I caution is, if there is an instrument in the market wherein the volatility is not 10%, 20%, 50%, 100%, the volatility is tenfold. You have to be cautious. Let's be honest. If you are putting your hard-earned savings into cryptocurrency, you have to be mindful of the fact that while on one hand it has gone from $3,000 to $23,000 yesterday, but what happens when it comes back to $2,000? So my sense here is, from a retail investor perspective, if and here I would go to different motives behind holding money. If you have speculative needs and you can afford, and you want to keep 10 to 20% of your portfolio in cryptocurrencies, absolutely go ahead. in my view, enter into the cryptocurrency when there is, downfall in the market. Right now, the market is being driven by liquidity. And because of this liquidity, if you enter into cryptocurrency right now, for retail investors specifically, I would say this may not be the right strategy until or unless you have, enough money on the side and you want to put it into some gambling activities. I'm okay. You can do that. But for those who are planning for retirement, those who are planning for their future, of their children education and so on and so forth, I would think cryptocurrency is not the right answer for it, especially at this time. When the market goes down, enter into cryptocurrency from a long-term perspective, so that, even if, let's say in the interim, you lose value, in long run, it should be fine. So that is my view on cryptocurrencies. In India specifically, I know that the regulator has been concerned about it. RBI has raised concerns about it at different international forums, and I do relate to it.
Thank you so much, sir. I'm sure, especially for the investors of today, this actually gives them a lot of insights that we need to keep into mind the risk that is associated and not just go blindly into it. So, yeah, your perspective definitely it should be taken in a very considerate manner by all of us. Okay, so the next question has just popped up in the chat window. Let me just read it out to you. So, in your opinion, should RBI grant banking license to corporate houses and allow for ownerships in spite of several failed instances of corporate governance, and whether this would add value to the GDP?
Yeah, this topic is controversial overall, and if I look at the experiences of other countries which are having, history as long as India, there are examples wherein issuance of banking license to corporate sector has worked well. The problem comes in during the times of crisis, because what happens is, let's try to get to the next level of detail and understand what is the implication of giving banking license. So you are issuing a banking license to a corporate house. So in essence, what happens is that the corporate house is able, through that banking license, through that banking entity, is able to mobilize the deposits from the retail investors. Now, till the time you are able to manage your asset side well, and you are able to generate enough returns to satisfy your providers of funds, that is deposit holders, your bond holders, and your equity shareholders, this arrangement works absolutely well. This is fantastic. There's absolutely no problem in that. When does the problem start? The problem starts when you are not able to manage your lending book well, and you start seeing the defaults. You start seeing depletion in your investment income because the stock market or the bond market or the alternative asset market has gone down. Now, this is where you start facing problems. And then comes the issue of that, whether your capital is going to be adequate to sustain those losses. And I do understand that, when you talk about capital adequacy, there are laws in place. You have Basel III now with Basel IV capital adequacy norms. Things are shaping up. But crisis after crisis, one thing that we have realized is whenever a banking institution fails, who is the lender of last resort? It is the government who is the lender of last resort. And you would have seen even in India, whenever some banks have been failing, then you would have a big brother who is actually supported by the government who takes over that. So while I am a supporter of more liberalization, I am a supporter of free market, I would think that when you are issuing licenses to corporate houses, what you need to ensure is you need to start putting in extensive controls relating to governance. And when I say governance, what I'm referring to, I am referring to related party transactions. You have to have very strict regulations around it. You need to have a well-functioning board wherein the independent board members are able to have an effective oversight, and they should be in a position to exercise enough control over the decisions which are taken. If you are able to manage it well, there is absolutely no harm. And I think, in a free market, you should get a banking license and you should be able to run a bank.
Thank you so much, sir. So, yeah, we have another question has just come in for you. Should I post it to you? Yeah. So, okay, so a junior of ours, like this is someone from finance domain, has asked that how has the growth in private equity for corporate funding affected the Indian financial markets, and especially in light of COVID, what changes in the trend do you expect in future?
Okay, so private equity is one area wherein I think there is a significant growth globally, and based on my knowledge, it's shaping up quite well in Indian market. I think one thing that we need to understand, for a country like ours, for the future growth, what do you need? You need to promote entrepreneurship. I know that this has been a policy matter that subsequent governments have, touched upon. But have we adopted significant measures in terms of promoting entrepreneurship? Although I am not an expert in Indian economy, but I doubt very much based on the knowledge that I have. So private equity culture, it does help to promote that entrepreneurship. And from that perspective, what I see is when you have a population which is young and growing population, wherein you have educated masses who are coming to the fore, and there is that spirit of entrepreneurship, a healthy private equity culture should help the country as such and should boost the financial market, certainly. What you need to be careful about, the adverse impact of private equity is that private equity players, they work in a very specific manner. At the end of the day, what is their objective? Their objective is profitability. And what kind of profitability they are looking at? They are looking at abnormal profitability. So private equity player is not looking at 10, 15% sustainable returns. Private equity players are looking at 100, 200, 300, 400% returns. And there is that, intention to exit through the financial markets. Now, in environment like this, I would think, especially in the next decade, private equity culture is going to be promoted more and more. To the extent our markets are not, unreasonably influenced by the liquidity consideration. And there is some consideration given to the fundamentals. It would be a healthy growth. But like right now, if the markets are being driven largely by the liquidity considerations, then I think I would be selective when it comes to private equity. And I would take it on a case-by-case basis.
Thank you so much, sir. That again provides a lot of food for thought to all of us. So, sir, before we close the Q&A session, like on a personal basis, I have just like one question has come to me. Although Mr. Shekhar has already shared his views on this, but I would like to pose the same question to you once, that about the current disconnect between the stock markets and the economic growth. And as you're working in the financial markets, I would just like to understand your perspective and rationale for this conundrum.
Yeah, perhaps in a class setting, I would give you the most honest answer to this. But when I'm being recorded, actually, I would be a bit careful in answering it. Okay, let me open up now. So my view is that stock markets all over the world are driven by the sentiments. Okay, and stock market volatility is not driven by the fundamentals in short to medium term. In longer term, I would agree, yes, it is driven by the fundamentals, but short to medium term, stock market is not driven by fundamentals. Let me give you an example. If you just pick up the newspapers, okay, any newspaper or any website, and look at daily news on how the Dow Jones index is moving day after day. So what will happen is, one day there will be a news, there is a positive development on US stimulus stocks and the COVID vaccine. The stock market goes up. Then the next day, when the stock market goes down, the news is, and the way analysts are trying to rationalize it, they would say the stimulus stocks seem to hit a halt, and this creates nervousness in the stock market. Now, tell me one thing. The underlying stocks which are being traded in the stock market, has the fundamentals changed from one day to another day, from 1 week to another week? The answer is no, the fundamentals have not changed actually. So what is happening is, when you look at stock market valuation, what I see is a large part of this valuation is driven by the sentiments. And here I would use a specific term, given that my background is from research, is there is irrational exuberance in the financial market. And the point is that at any point in time, I would expect irrational exuberance as well as rational sentiments. They should coexist. But there are times when you see the former would take over the latter. And when the former takes over the latter, this is where the problem lies. So I don't think that stock market really reflects the real economy. It's only in the long term that trends are aligned with the real economy. But short to medium term, it's about how the sentiments are moving, how is the liquidity situation in the market. There are big players in the market, and nowadays people talk about algorithmic trading. I find it absolutely utter nonsense. And the reason why I find it utter nonsense is that what you are trying to do is you are trying to promote trading, not the investment. So algorithmic trading is all about creating a trading environment wherein you have a combination of stop losses and limit orders through which you are trying to make profit. That is what algorithmic trading is all about. So I think stock market movement, is it aligned with the real economy? Only in the long run. Short to medium term, it's all about how do you make profit. I hope I did not disappoint you.
No, sir. You actually cleared a lot of doubts, and it was really, I was enamored by listening to you, because when you said that if this would have been a classroom session, and between being the session, still you managed to, there's a certain thing that we read in our books and there's a practical perspective. You managed to bring to light both the aspects, and yes, if I am able to gain clarity, I'm sure all of our audience is able to gain that clarity as well. So thank you so much. It was very nice interacting with you.
Thank you very much.
Hello. Good morning, Dr. Sandeep. Thank you for your insights. I have a question. I'm a faculty at the Lal Bahadur Shastri Institute of Management. So I have a question. I've listened to your talk, and relevant were the 7 themes which were mentioned by you. I had a couple of questions. One question was on cryptocurrency, but since you've talked a lot on cryptocurrency, my second question would be was on the policies which you were talking and the innovations they bring. So when policies come, there are innovations, and when there are innovations, a lot of opportunities. And with opportunities, of course, there will be a lot of risks which will come. As we move from, say, a bank-dominated structure to a market-dominated structure, which India is moving, so do you think, are we ready for the kind of risks that will come moving from bank-dominated to a, say, market-based structure?
Absolutely pleasure to be interacting with you. I think when you say bank-dominated to market-dominated structure, I think there are instances wherein you have seen a move from bank-dominated to market-dominated. My view is that if you become too much market dominated, there are some risks that you are not able to foresee. There are some risks you are not able to envisage. And if I take you back in the history, although I'm not that old, but still, when I look at from a historical perspective, what happened at the beginning of this millennium? What we saw was that there were significant gaps which were there in the way disclosure of financial information was done to the market. And you know, the market acts on the basis of the financial information that was disclosed. And then what US did was, while there, Enron crisis happened, Arthur Andersen collapsed, all those things happened. But then what the regulator did, the regulator came up with something which was very draconian, Sarbanes-Oxley. Did it contribute significantly to improve the quality of disclosures in the market? Having worked in Sarbanes-Oxley for 5 to 7 years, I can tell you, Sarbanes-Oxley was a control-led regime which did not help the financial innovation in the market. It did not help in terms of improving the market information. What it resulted in was, it resulted in something, a mechanical set of controls which all organizations were supposed to be implementing. So my sense there is that you should not be shifting from bank-led to market-led. There needs to be some balancing act that you need to do. Because what happens is, if you move too much towards the market-led environment, during the times of crisis, it becomes very, very difficult to control it. And let me give you an example there. I was in 2008 when this global financial crisis hit. I was in London at that point in time, and this Lehman Brothers collapse, it happened over the weekend. When it happened over the weekend, many of my clients, which are large clients dealing in billions of dollars, they did not have a clue in terms of how much total exposures are we holding towards the Lehman Brothers. Because what was happening was that exposures were there in bonds, exposures were there in commercial papers, which are unsecured, as you know, exposures were there in some of the, overnight lending in the interbank market. And aggregating that exposure and getting a view in terms of how much money is at stake was not that easy task. So what I would say is that there should be a balance between these two. And because during the times of crisis, you will be able to exercise more control on the banking flows as compared to the stock market flows. And in stock market, whether you like it or not, there is a herd behavior that you would see all the time. So I think shifting control is not the right thing. What should be there is a balance, and that balance would be very healthy, especially during the times of crisis.
Thank you, Sandeep ji, for your great insight, and I hope our students would gain a lot. I am Dr. Anuj Verma, a faculty here in area of finance. One last question, because I think the question answer session has been great and it's been very long. You've been answering the questions one after the another. My last question is that since you talked about the cyber laws and the data confidentiality, see in the Indian scenario, since the cyber law regulatory framework is very weak. So and all the financial markets are now currently online and everything, all the system is online. So what do you see? What changes we need to bring in to maintain that risk?
So, no, it's always a pleasure to interact with the faculty members and students of LBSIM. I have my fond memories, as I said, so absolutely pleasure for me. Now, on the subject of cyber laws, if I'm honest, I would certainly like to say that the innovation that has taken place in the technology world, we have not been able to keep pace with those innovations from a regulatory perspective. And that is why what you see is that the regulators are playing a catch-up game. And this is not the situation in India, by the way. Let's be honest. This is the situation worldwide. And, although in Europe, they have GDPR, which is a regulatory regime from a data confidentiality, data privacy perspective. But at the same time, today, there are a number of instances which are happening in terms of the confidentiality breaches. And, organizations are trying to play a catch-up game. I gave you the example, PwC Global Chairman, he called all the, partners in a meeting, and we came to know that, how many attacks were there over the weekend. Some of those attacks were, emanating from specific countries. So I think this world is a very complex world. And my understanding at this point in time, although I am not a technology expert, but I do interact with our technology expert and the cybersecurity experts on a daily basis. My understanding is the following. My understanding is that at this point in time, we do not have complete handle on the types of risks which are there in our system, which are emanating from the current technologies. So that is fact number one. Fact number two is, while we are taking all the measures which are possible and which are conceivable, there is a fear of unknown that is there. And because of that fear of unknown, what we are not able to do is, we are not able to control all those risks. So if I take some of the recent examples, so what happened? There was an attack on Saudi Aramco, which is the largest oil company in the world, and the entire network was jammed. What was how did they deal with that situation? The way they dealt with that situation was the entire technology infrastructure was taken off network for many days. Now, just imagine, had they been on cloud, and that too the public cloud, what would have happened? How can you take the entire infrastructure away from the network? You cannot. So I think, this is an area wherein the unknowns are more than the knowns. The way, cybersecurity laws are evolving, they are doing the catch-up game at this point in time. And I think, whenever we are dealing with areas which are exposing us to extreme data confidentiality breach and all, what we need to do is we need to always have the backup plan. And that is why today, when I advise some of the large corporations, some of the large banking institutions, in different parts of the world, one of the things that, we try to promote in the current environment is you need to have very strong business continuity management and disaster recovery plans, because anything can happen at any point in time. The fear of unknown is significant. So what we are trying to do is we are trying to have such strong backup mechanism so that once you are attacked from a cybersecurity perspective, you are able to invoke your backup plans immediately. So that's the way we are currently working. No one has a clear handle on this. I would think that, Apple is one organization which has mastered this to a large extent, but with some of the recent attacks, I have my doubts on the security level there as well.
Thank you so much, sir. It was indeed an insightful session. I would now request Dr. Pankaj Varshney to felicitate Dr. Srivastava with a memento.
Thank you very much.
Thank you. It It is indeed a pleasure to inform you all that we have the august presence of our beloved chairman, Shri Anil Shastri ji. Shri Anil Shastri, son of Shri Lal Bahadur Shastri, second Prime Minister of India, graduated in economics from St. Stephen College, Delhi, and did advanced management program from Ashrat Management College, UK. He has done General Management Program from Administrative Staff College of India, Hyderabad, and Business Management Program from Tata Management Training Center, Pune. He has served the corporate world for around 2 decades at very senior positions. He is Chairman, Board of Governors, Lal Bahadur Shastri Institute of Management and Technology, Bareilly, and also Chairman, Board of Governors, Lal Bahadur Shastri Institute of Management, Delhi. He is an active member of Indian National Congress and an active member on Twitter. Thank you, sir, for being here with us today. Now, I would request Miss Aparna Gupta to present sir with a bouquet. Thank you so much. Nivesh, the LBSIM Investing Club is releasing the year-ending edition of their magazine Nivesh Mag. Before the release, I request Mr. Aditya Pillai, PGDM Finance second year student and team member Nivesh, the LBSIM Investing Club, to appraise us about the magazine. Please, Aditya.
Good afternoon, respected dignitaries and students. It gives me immense pleasure and pride to present 2020 edition of Nivesh Mag, the annual magazine of Nivesh, the Mutual Fund Society of LBSIM. Nivesh Mag is an output of almost a year of dedication and hard work shown by Team Nivesh. The magazine encapsulates numerous sector reports which presents in-depth analysis of sectors of Indian economy, editorial section which gives an insight on various finance topics, and a special year at a glance section which mentions the major happenings of 2019. I would like to thank Nidhi ma'am who supported this initiative and acted as a mentor for the magazine. I also want to thank Team Nivesh who helped put together this magazine. Thank you so much all. Hope you like it as much as we do. Thank you.
Thank you so much. Now, may I request respected Chairman Sir, along with Dr. Nidhi Malhotra, Assistant Professor, LBSIM, and all the esteemed dignitaries present on the dais to offer floral tributes and to officially release the magazine. Please, sir, please, ma'am.
Thank you, everyone. Listening to such great minds has been nothing but enriching. And on this note, we have finally come to an end of our inaugural session. I would now like to request Professor G.L. Sharma, Head New Projects, Advisor Corporate Interface, LBSIM New Delhi, to deliver the vote of thanks. Please, sir.
Very good afternoon. We have almost 2-hour session. Mainly two speakers were there, Mr. Vidhu Shekhar and our very popular Sandeep sir. At that time, we used to call Sandeep sir, then he becomes a direct PhD. So Dr. Sandeep sir. The two gentlemen have explained the changing scenario in the finance sector very aptly. And both of them have described that these are the changes, these are the factors responsible for the change, and these are the factors likely to affect more changes. Particularly, Vidhu Shekhar was clear that three factors have affected not only financial market in India, but elsewhere also. And he highlighted the technology, regulator, and domestic and international trade or market. He also outlined various factors, particularly regulatory, because he was deputy chief of Stock Exchange, Bombay. So he pointed out regulatory, and I personally feel that whatever regulatory system we have in India, still we have not up to the mark. Still there are various problems which can be highlighted anytime. Dr. Sandeep or Sandeep sir, I'd like to point out to the students of LBSIM. We were a very small institute when we were in Arkepuram. Ground floor, first and second. Director used to sit in the ground floor. I used to sit in the first floor. Sandeep sir used to in the third floor. And that was the strong foundation laid down by the faculty of LBSIM so far finance is concerned. We didn't have MCA, so technology was missing. Library in basement, few books, Nandi was maintaining. Probably top there was a computer center, few computer. We have probably still the same gentleman is there. So with small few faculty members, but the teaching was so difficult in the sense that the grid has maintained a standard that those who come 5 minutes late don't disturb the class. Automatically they will outside the class. And one of the situations I very well remember, where Mudit Sastri was the student, Renu Puri was HR, head and delivering the lecture. I was officiating as a director. 13 students came late or did not answer, and Dr. Renu Puri asked them to go and line up the gate, because she knew that I normally come at around 11, and the first period will be over by 11. When I entered the gate, I found 13 students on a row standing. And the first student was Mudit Sastri. And fortunately, because Mudit Sastri, son of our chairman. So the feeling was that Dr. Sharma may ignore and allow, so Mudit was first. I asked Mudit, why you are here? Sir, I'm late. 1, 2, 3, he said, we are late. So what should be the punishment? He said, whatever you feel. I said, I asked the gatekeeper to open the door. I asked them to go out of the institute. Because time is very important. Everything you can get back, but not the time. And that was the situation, that was the period where we laid down strong foundation of Lal Bahadur Shastri management, and that is why today we are here. And Sandeep sir, as popularly known, was the star attraction of the game, finance. And anything Sandeep will tell, sir, मैंने ये कह दिया है, इसमें कोई change नहीं होना चाहिए. I said, no change. Whatever you have done, it's a final word, no change. So the institute has been progressively increasing day by day, but the foundation stone has been very strong. And that is why we hope in the next few years we will be at the few institute in the country will be particularly in different areas. The finance will be at the top. Of course, technology is going to be at the back of it. Various factors have been discussed by the two speakers. Sandeep sir, straightway, he doesn't reject it, but he is not fair of cryptocurrency. And of course, the fundamental principle of any currency is store value. If it cannot store value, it cannot sustain forever. So cryptocurrency is likely to be any time to be destroyed. Professor Negi has raised a question, probably banking, market-based, bank-based economy or market-based economy. Professor Negi, my impression is that if you are heading toward market-based finance, going to disasters. Because if you look at the history of last 20 years, finance, banking, market, other regulators, we are heading toward a situation where 80% people will not have anything, market economy. And recently you have seen the COVID 2019-20 has brought to the notice of the public at large throughout the world that there is a gap, wide gap, between haves and have-nots. And that is a real danger. Intangible assets, probably Sandeep sir would be listening. Intangible asset increasing like anything. Stock exchange, Shekhar sir, you know, 47,000, no relevance. Only few companies, I don't want to name them, only few companies, they are creating this situation in such a manner that every day there is 500, 1,000, 200, 3,000 increase in the stock market. Or Nifty, 13, 14, unimaginable. So what is going to be, because this is the government has to take into consideration, the central government, the state government, social media, and other persons to see that if this continues for another 4 or 5 years, there will definitely be a very difficult situation. Nobody will be able to manage them. So I think Sandeep sir or Bindu Shekhar, please note that the COVID has given an opportunity to bring to the notice of the public that the situation is very, very dangerous, and we have to take into consideration 70-80% of the population, that they must have at least not decent life, but at least food, shelter, and medicine. That's my conclusion. So I express on behalf of the Institute, the two gentlemen, Dr. Sandeep and Mr. Vidhu Shekhar, our thanks, our gratitude for accepting our invitation. Very short notice. Probably Sandeep sir accepted our invitation in only 2 days. And he said, sir, the institute ka hai, to I am part of the institute. As I said, and he said himself, he started his academic career from the LBSIM. So basically he's a product of LBSIM. So we thank you both of them. We also express our gratitude to our chairman for gracing the occasion and releasing the the magazine the students are maintaining, I think for this 7-8 year. 7-8 year, they are maintaining. It's very difficult to maintain, to bring regularly a magazine. It requires a lot of pains, a lot of efforts. So thank you them also. And particularly, we express our gratitude to the chairman because we always get confidence when he is there. Confidence building, because the situation at the moment all over the country is trust deficit. And if trust is there, things will become positive, things will be favorable. I express my gratitude also to Dr. Praveen Gupta, Director, Pankaj Varsne, who has organized the conference, drafted the report and drafted the various session, arranging various speakers. Both of them deserve a congratulation. Also the faculty of finance area deserve our congratulation because it's not one-man show. As we know, there is a book, there is a shop known as One-Man Show, but it is a collective show. So all faculty members in the area of finance have contributed significantly in arranging the conference. Particularly, I like to thank our student who really put good question, and Sandeep sir has appreciated that the students are asking such a difficult question, and they answer very well by Bindu Shekhar and Sandeep sir. So thanks to the students also, and to the staff, administrative staff, including Chief Administrative Officer and other members of the staff for arranging this seminar. But at the same time, I would like to request Sandeep sir and Bindu Shekhar to ponder over that the entire, but because we have to see our own context. So if you look at the own context, situation would be very difficult, and this institute, academic institution like Lal Bahadur Shastri Institute Management, it is a primary duty of our duty to bring to the notice of the public that these trends are likely to create more problem than they solve the problem. So thank you very much. Thank you. Thank you.
Thank you so much, sir. Moving forward, we now have an insightful panel discussion on the topic The Changing Face of Indian Financial Markets Roadmap for the New Decade. I would now take this opportunity to introduce our panel discussion moderator, Dr. Anil Kanungo. Dr. Anil Kanungo is a professor and area convener, Department of Economics, LBSIM Delhi. He has over 29 years of teaching, research, and consultancy experience in the areas of economics, international trade, and business. Previously, he has spent more than 2 decades as a senior faculty at Indian Institute of Foreign Trade, New Delhi. Professor Kanungo's work has been published in various renowned national and international journals. He also writes a column in the Financial Express, a leading business daily, and he has presented papers in various national and international conferences. Sir, we are honored to have you here with us today. I would now request you to take up the dais as the panel discussion moderator. Please, sir.
मिक्सिंग चल रही है क्या? कैसे आवाज आ रही थी?
Thank you, sir. Moving forward, we are honored to have the august presence of our esteemed panelists who have joined us virtually today. Ms. Rosemary Abraham is the first panelist for the day. Ms. Abraham is the Joint Director of Financial Markets Division in the Ministry of Finance, Government of India. She has various articles published around diverse background in multiple publications on the topics like resurging industrial sickness, trends and patterns, disinvestment of public sector enterprises, time to proceed without feeling guilty. She has also specialized into the know-hows of market functioning and analysis. I welcome you, ma'am. Next, I would like to introduce our panelist for the day, Mr. Vijay Sardana. Mr. Vijay Sardana is a member of Commodity Derivatives Advisory Committee, a well-recognized professional in the corporate world for his expertise in techno-legal and techno-commercial matters. He is on the board of various organizations, is also a well-renowned speaker, writer, author, blogger, and a corporate trainer. Mr. Sardana was awarded for his exemplary work and contribution by late Shri Pranav Mukherjee, former President of India. He also received the Global Agriculture Leadership Award for his contribution in development of food businesses and commodity trade by Governor of Haryana and Uttar Pradesh. I welcome you, sir. May I now request Ms. Akshi to take the proceedings forward.
Thank you, Soumya. I would now take this opportunity to introduce our next panelist, Professor D.K. Malhotra. Professor Malhotra is a professor in finance at Thomas Jefferson University, Philadelphia, USA. He teaches courses in fixed income securities, international finance, corporate finance, and financial risk management at the undergraduate and graduate levels. Dr. Malhotra has published various articles in renowned national and international journals. He is the editor-in-chief for Afro-Asian Journal for Finance and Accounting. He is also currently serving on the editorial boards for various international journals. He was also the recipient of 1999 President's Award for Excellence in Teaching at Philadelphia University and 2000 Philadelphia University Outstanding Research Award. He has received the School of Business Administration's Award for Excellence in Research for 4 years. Our next panelist will be Mr. Naveen Gupta. Mr. Gupta is a zonal head retail banking at ICICI Bank Limited, presently handling Delhi NCR, which is one of the largest financial markets of our country. He is a finance professional, holds a master's degree in business administration with almost 2 decades rich experience in banking industry with various corporates like HDFC Bank, Global Trust Bank and ICICI Bank. He is a dynamic leader with great business acumen, has a customer-focused approach, and believes a satisfied customer is a promoter of the brand which helps to acquire the leadership position in the industry. A leader under whose umbrella team ICICI has created benchmarks and enjoying market leadership across various banking products and services. His vision and ability to identify continuous improvement opportunities within the business is a driving force behind every success. Thank you, sir. Lastly, we have in our panel Professor Madhu Vij. Professor Vij is a professor of finance at the Faculty of Management Studies, University of Delhi, where she has been teaching for over 3 decades. Her professional and teaching interests include the areas of international finance, risk management, corporate finance, and accounting. She has received the Alumni Excellence Award from Sri Ram College of Commerce, University of Delhi. Her research interests include asset liability management, country risk analysis, foreign exchange risk management, to name a few. She has completed a number of projects sanctioned by national bodies like UGC, RBI, SAIL, and Delhi University. She serves on the editorial board and is also a reviewer for several academic journals, national and international conferences. Professor Vij has published several research papers in international and national journals of repute and has presented papers globally in the field of banking and finance. She has also authored 4 books in the field of finance. We welcome you all to today's panel discussion. I would now like to hand over to Professor Anil Kanungo to take the proceedings forward. Please, sir.
Much. Very good afternoon. I have the pleasure and the privilege to be a part of this event duly organized by Department of Finance, Lal Bahadur Shastri Institute of Management. At the outset, therefore, I would like to express my thanks to Dr. Pankaj Bashne, currently Chair, Department of Finance, LBSIM, and to Dr. Praveen Gupta, currently Director, LBSIM. Finance is not my forte. Having done economics and international trade, I believe these are the contiguous areas where I have decided to learn. That's precisely the reason why I'm today here. I'm quite sure that I'm addressing currently a very informed audience and especially a set of panelists who have made a huge mark in their domain and have a significant track record to prove for themselves. Looking at their CVs and their track record, actually I feel quite intimidated by their contribution that they have already made. Therefore, I would be rather more of a listener here rather than participating in the discussion. I would like to intervene at certain points wherever there is a dire necessity to do so. Now, when I look at the proceedings that I observed in the morning, I found already there is a great amount of momentum set already in terms of discussions and in terms of areas that needs to be covered. That immensely makes my task actually easier. Before I request and invite each panel member to speak for about 10 to 11 minutes on their specific areas and on their domain, I would like to make a few points about what it's all about that we are perhaps going to discuss. In fact, I'm going to raise a couple of questions which are absolutely in my mind and should be in the uppermost minds of many. To begin with, I would like to first pose very significant questions which have been talked about in the inaugural, but I believe I haven't found any kind of a right answer to that. Now, can current global financial architecture provide some kind of a surety that we are not going to witness any kind of a reoccurrence of global financial crisis? What I'm basically hinting at is there a foolproof system by which we'll be not noticing any kind of a global financial system occurring again and again. That makes me to ask the second question. Post-global financial crisis, I noticed there has been a serious lack of actually cash crunch and liquidity in the market. Therefore, many firms and institutions, and financial institutions especially, were in a great hurry actually to lend out perhaps credit to a few and to a large farm owners without in fact verifying many of the things. That means the point I'm raising is that if there has been a post-global financial crisis, cash crunch has given rise to maybe some amount of NPAs or non-performing assets that have set in actually in Indian context. Indian economy is also globally connected. Therefore, I cannot see that Indian financial sector is completely remaining aloof or in a vacuum, not integrating with the global economy. Then I raised the question that why Indian financial system, which took a lot of pride earlier in stating that we have a very robust and strong system, but suddenly we find that there are many lapses in the financial system, basically showing us that some kind of a degeneration has perhaps taken place. As I notice, in this year, especially Yes Bank, and the latest in the series is the Lakshmi Vilas Bank, which tells me that there are many such incidents which perhaps in the pipeline could actually come out of the close, or the skeletons are going to be emerging out of the close. Now, why such kind of a no check on the reckless lending that the Indian financial system actually had initially? What made SBI to go for a takeover with Yes Bank? Why not there was a merger? Why there has been a merger actually with the DBS Bank with Lakshmi Vilas Bank? What makes us feel that there are institutions which are already there to tell us that such kind of things will be taken care of and would not happen? Is there certain institutions which have been created to provide any kind of a security or full security in Indian system so that we don't see any kind of a financial disaster happening? When I look at my volatility markets, especially the commodity markets which are largely volatile in nature, would it mean that high volatility in commodity markets makes my policy corrections difficult or policy making difficult? What are the terms and conditions that can be set in terms of insurance sector to make actually everybody aware of the insurance that we need? We are very sure about the insurance that when we buy actually our vehicles or we buy actually our smartphones, but we are not sure of insurance and how it works actually when I'm looking at my real estate or my property prices. Why insurance sector is so lacking in terms of spreading awareness? What are the other disturbing scenarios that I can look at when I'm looking at actually India's financial sector? For instance, is there a relentless market pressure on the investors to actually maximize their returns? Why sometimes co-investors are rushing in to bail out actually a decrepit market or financial system? There are so many questions which comes to my mind and which can be raised in due course, and I believe these are going to form part of my discussion. Therefore, I may not be dealing and wasting so much of time looking at what I need to actually ask. Maybe in due course we can actually get into those nitty-gritty of the problems and crisis. Having said that, before I begin and invite, I have great pleasure in stating that we have very high senior government official who's going to give us actually a very ringside view of how government has been always actually a savior as far as certain financial crises are emerging and considered. Therefore, I would like to actually request Mrs. Rosemary K. Abraham. It's a great pleasure to have you in our midst this afternoon, Mrs. Rosemary. I would like to give you about 10 minutes time. You could also speak on the specific area that you would like to actually speak. Welcome to you, and over to you, Mrs. Mary Abraham.
Thank you, Professor Kanungo. Am I audible?
Yes.
Thank you.
Distinguished panelists, my dear students, ladies and gentlemen, very good afternoon to all of you. I would really pick up from where Vidhu and Sandeep left us with. But before going into that, let me tell you that you have to hear me not as director to Government of India. I'm a student of finance. I'm a researcher. So allow me to be wild and dreamy and share my dreams and thoughts with you. If I have to define myself as director to Government of India, I would be really constrained. I'm hearing the speaker here. Is there any way in which I can minimize that? Okay, never mind. So,
if your mic is on, you can switch off that.
My mic is on. Can I
switch off that and just keep the microphone on and switch off your mic. That will avoid this echoing.
Am I audible now?
Yes, now you can.
I have switched off my speaker for the time being. I'll keep it on once my speech is over. So what I was saying is you have to hear me as a researcher, as a student of finance, not as director to Government of India. And what I'm going to say here is my dreams, my thoughts about the changing course of the financial sector. And this in no way reflects the views of my employer, which is Government of India. And you should not be even wildly thinking that these are issues which are under consideration of Government of India. Now, coming to financial sector, we often say that there is a sound mind and a sound body. In the same way, I could say that a sound economy depends on a sound financial sector. A sound financial sector really determines the ease with which you build your homes, the comfort with which you would survive your emergencies like life and death in your family, the ease with which an industry would set up its plant and machinery, the peacefulness with which we would retire. But over a period of time, as some of the other fellow speakers have been pointing out, finance has occupied a significant portion of our brain power. Most of our IITians and IIM graduates are busy working in investment banks. So lot of good brain power has come into financial sector. Now this has led to a lot of financial engineering and innovation, and some of these innovations have gone terribly wrong. For instance, take the case of securitization. This has helped us, do a temporary warehousing of risk, but, terribly skewed the asymmetries, information asymmetries, and gifted us the global financial crisis from which we haven't even got out. There have been a lot of references about the irrational exuberance of stock markets. I heard, many people asking a question about that. So there is a disconnect between the financial sector and the real sector, which many of you believe. Now, if you go back to your textbook learnings, we were always taught that money is a whale, and financial sector should just facilitate the real sector. But in a way, financial sector has kind of hijacked the real sector and has, to a great extent, stalled the progress in the real sector. Some of the practices in the financial sector reeks of unfairness and inequality. For instance, some of them were referring about algo trading and co-location. Now, machine logic, those who can afford to pay for the machine logic would have the benefit of algo trading. Think about co-location. This is an inherently unfair system. But then, this has already been taken place in the financial market, and it's going to stay there as it is. So it is in this context that I would like to bring in my theme. I want to focus on how to make our financial market socially useful. So this is broadly the theme on which I would be talking, and I would like to throw some provocative dreams to you. Now, the most marginalized segment of any society, look at farmers. Now, the farmers are on protest here, and what is their major concern? They want price insurance. At the time of sowing, they are looking at some price, and on the basis of that, they have decided to sow some crop, but at the time of harvest, they are not able to realize that price. So what if we could use our financial markets to make them lock in their price at the time of sowing itself? Whether we could think of developing some instruments called options, which is nothing but an MSP in an OTC style. MSP is essentially an option in an OTC style. So if you could think of an option instrument, which is a market mediated instrument, to help farmers lock in their price at the time of sowing itself. Now imagine, in addition to NAFED, Harvard, and all those government procurement agencies, we could think of making banks, insurance companies sell this price insurance to farmers at for a premium. And these are financial institutions. They could in turn come back to the commodity derivative exchanges and take contraposition. These are not easy reforms. At present, our Banking Regulation Act does not even permit banks to deal in commodities. So what I'm telling you right now is kind of some, wild imagination for making my financial sector useful for the real sector. And we could deliberate on how we can actually go about with that. Now, imagine a situation like the farmer at the time of sowing itself, he couldn't lock in his price. But when he has come to the harvest time, if he could actually stay on for some more time, he may be able to get a better price. What if we could actually give him something called an electronic negotiable warehouse receipt, which he could use and go back to banks and get some concessional finance on that? Since it is a third-party accredited negotiable warehouse receipt, there would be more comfort for banks to give him a concessional finance. And if this electronic negotiable warehouse receipt were to command the confidence of the market, which will come from, if there is a real strengthened regulator like SEBI for electronic negotiable warehouse receipt, WDRA right now has got some constraints, legal constraints there. So if you could strengthen WDRA to be a regulator for ENWR, and then could take on the problems that could come from fake issue of warehouse receipts, etc., then there would be greater confidence in this instrument. Once this instrument matures, probably we could have a repo facility on electronic negotiable warehouse receipt. Right now, repo is basically happening on the government securities. Repo is nothing but a disintermediated, borrowing facility, financing facility. So what if we could build a repos on electronic negotiable warehouse receipt? We could actually give some working capital to the financial sector players. So these are some of the ways in which we could reorient our financial sector to address some of the issues of the social sector. Now imagine for a minute, what if I could frame a stock exchange style of financing facility for academic institutions like Lal Bahadur Shastri Institute, or for any academic institutions which are organized as societies and trust. A small beginning has been made with the announcement of social stock exchange. We are ready to put that in place. I don't know the final contours that SEBI is going to put in for the social stock exchange. But for a minute, if I were to think of social stock exchange as a platform for facilitating financing for the trust, societies, NGOs who are there to give last mile connectivity to the masses, then there is nothing like that. Now imagine for a minute that we could introduce something called an impact bond into Indian financial market. There is an earthquake in Delhi. For a moment, you believe that. And there has been some destruction. Now, what if we could actually issue some kind of a project bond and then raise finances for that project? When we are raising it on an electronic platform, we are also bound to some disclosure norms. So we could actually give some, when we are raising finance, we will say that, okay, I have raised this much amount of money from market for my earthquake or calamity bond, and then I will give a report card at the end of my term. If I had borrowed for 2 years or 3 years, at the end of it, and in periodic terms, I will make a disclosure to the market. This will bring in a lot of transparency into the system. Now, I'm requesting you to stretch your imagination a bit more wild. Okay, what if we were to say that our political parties, say for Congress or BJP, if they're running an election campaign, they could actually organize their funding through these platforms. Now, with the developments in fintech, we could actually make even 10 rupee contribution, costless. Is the marginal cost of doing a 10 rupee donation is nothing. So we could actually think of that. And this would bring in a lot of discipline into something called, election funding, and it would bring in a lot of transparency. What if we could actually link our voter's ID card to the Aadhaar? So then, you just need your Aadhaar. Based on your Aadhaar, you just make your 10 rupee or 50 rupee contribution. And this would remain anonymous, and you could, actually clean up the system quite a lot. So there are various ways in which we could think of utilizing our financial market. And now going ahead, there are some challenges involved in that. One of the most important challenges that I see that regulators would face is to balance privacy and bring in some kind of information dissemination to disinfect the system. For instance, think about your insurance distributor or your broker. Most of the time you would have purchased an insurance policy based on the distributor's gyan about, sir, ye to a product acha hai, wo product acha hai. But you may be fooled because he might be actually selling you a product which gives him the best commissions. So what if we had a system like Uber drivers? How do we rate him? After taking a ride, we give him a 4-star, 5-star. So nowadays, we are not actually regulating the distributors of financial product. What if we had a system wherein, the users could actually, those who have purchased the financial product could actually bring in a rating for his distributor? The peer pressure could actually discipline the whole distributors in the system. And what if the regulators were to map all those enforcement actions taken against one particular entity and then put it in public domain? So if I am buying some insurance product from a person called A, then I could log onto the system and then verify whether A is a credible entity to deal with. So these are some of the ways in which I think we could put our markets into a more socially useful terrain. If you recollect Mervyn King, he has written a beautiful book called End of Alchemy. So he talks about, we are living in a kind of radical uncertainty. Radical uncertainty is the things that we do not know that we do not know. So we don't know, where the risk ends and uncertainty begins. In financial markets, we are so conditioned to the, VAR modeling, value at risk modeling, where we know all the outcomes that are going to happen, and then we can attach a mathematical probability to each of those events, and then we can calculate the actual risk in the system. But this is not going to be the situation in future. So, what if we could actually, handle this radical uncertainty in a different way? Most of the time when financial sector crimes are confessed, then the resolution would flow in with taxpayers' money. What if we were to think about, the financial sector participants itself making a bit of contribution for handling the financial stability challenges? What if these asset purchase programs that most of the central banks in Western countries were doing could be part funded by the industry itself? So these are some of the thoughts that I have. As Franklin Roosevelt said, the progress of, the test of progress is not how much we have added to the abundance of those who already have, but how much we have improved those who do not have. So establishing the social connect of financial sector is, I think, something that we have to really consider, discuss, and debate, so that in future we will not have a serious crisis like that. I'm not saying, I'm not dreamy enough to say that there will not be another financial crisis. There will be crisis, and every crisis is an opportunity for us to improve and learn. So that is where I would stop, and I would take questions once the other panelists have spoken. Thank you.
Thank you, Mrs. Rosemary. It was wonderful to have heard you. And I believe you touched upon the things which I was not actually expecting. You spoke more in relation to what farmers are going to be. asking for and how farmers' agitation is going to actually shape up, if I may say so, that kind of a commodity market pricing actually. Because we notice that if I'm looking at my farmers' agitation, then certain kinds of commodity products which are actually very dire necessity for all of us, and they're part of the agriculture products. Now, agriculture products also forms part of the commodity markets. Now, if this agitation is going to shape up into a nationwide, then I don't know how we are going to handle actually commodity pricing structure. We'll come to that a little later when we open up actually the floor and we look at in a different manner. Thank you, Mrs. Rosemary, for your wonderful comments. My next panelist is Mr. Bijesh Sardana. He's going to speak on basically commodity derivative advisory board member and is going to possibly speak on commodity derivative markets. So it's a great, we welcome you, Mr. Sardana, and thank you for being here. We may continue to speak for about 10 minutes.
Thank you, sir. Thank you very much for this opportunity. I will take this issue a little bit on the wider side on the theme of the conference, that is changing face of Indian financial markets. Commodity is one component of it. Madam Rosemary has very nicely explained the issues and the challenges which a financial market has to go through. And it's a constant evolving process which we have to focus on. The problem in the whole financial market is if everything is smooth, then actually there is no crisis. If all the stakeholders are happy, whatever they are doing and making money, actually there is no crisis. The problems comes when we start thinking that somebody else is making more money than me. And then we say that, okay, it means something is wrong in the system. Or the policy is favoring X segment of the society and not Y segment of the society. We rarely look into that how money is made in the economy. The classic example is what is going on in the farmers' agitation. What is farmers' argument here? And that will give us what is the role of commodity markets. The farmers' problem is that I'm selling my maize or corn at 10 to 15 rupees a kg. But when I go to market, I see a same corn flakes, which is costing me something about 300 rupees kg. And if I go and buy that Act 2 corn, popcorn, it costs me 700 rupees a kg. And it appears that somebody is short charging me and I'm cornered and some people are making big money in the game. So if I am making or selling corn at 15 rupees a kg, what should be the price of cornflakes? Nobody is discussing that. Nobody is educating farmer that how cornflakes is made, what are the costs involved. Problem in the whole economic or financial system in India is the extreme illiteracy about the economic activities. We do not want to learn about financial systems. And the classic example is if you go and talk to any broking house in India and talk to all those so-called those who are issuing research reports that where to invest and where not to invest, please do a survey and find out where they invest personally their own assets. And you will find a stark reality there. People, those who advise that where to invest in which stock, they themselves never invest, they invest somewhere else. Because they don't trust their own systems in which they are operating. A person who is advising which stock is good, always either invest in real estate or in FD. What this indicates? This indicates that we have our own as professionals, we have not understood this market, except the reality. How many university professors teaching finance invest in stock market? Ask yourself. And this is my fundamental question to all my finance managers in the corporate world, that if you know how to make money and you're advising everyone else in the financial world, then you guys should be the richest people. But that is not the case. It means what? It means there's extreme illiteracy about financial markets across the forum. Why we should blame the farmer? And that is a reality. Now, issue comes up is, what is the way forward and how a biggest issue like agrarian crisis, which is linked to so-called commodity market, what role financial markets can play in this? And that is the moot question for India because 60 to 70% people are involved in commodity markets. Hardly 3 to 5% people are associated with equity market. But if you look into the education systems in universities, how many universities are teaching equity and how many universities are teaching commodity and what is the ratio? That shows that as even academic system, we are biased and ignorant of the ground reality. Accept the fact. Otherwise, 60% should go to commodity market, maybe 10% should go to financial market, maybe another 15% should go to banking system and other instruments of finances. But what we are teaching in colleges, even in IIM Ahmedabad, where I studied, 80 to 90% time goes in equity markets or financial markets. Hardly any lecture or even a passing marks on there is something called commodity market and thank you. And this is the hard reality when we do not have manpower in this country to understand economic scenario of the country and how to manage it. We have to head for this crisis which we are facing in the farmers front. Nothing new. It was writing on the wall. I was telling from last 10 years, we are heading for disaster. Today it is on front of us. You can ignore it for another 2 years by giving political concessions. Again, this will come back down the line 3 years. That's the reality of the world. Now, what is the way forward? Way forward is very simple. Focus on financial literacy across the board. Today, financial literacy is considered as an elite subject, which is sad part in any democracy. Financial literacy should be the basic knowledge, like when you start talking about ABC or Kakhaga or any basic knowledge or grammar of any language. Because money is equally parallelly flowed when we talk with any person in day-to-day transaction, whether it is buying vegetables or buying houses or buying car or anything. Financial literacy should not be considered as elite. And unless we change this mindset, this country will continue to suffer the problems. Because few people with vested interest will mislead rest of the society, whether it leads to banking scam or frauds or whatever, Ponzi schemes and whatnot. It is all because illiteracy is ruling this country, especially financial illiteracy. Now, issue comes up is, what is the role of commodity market? The farmer says, my job is how to grow. And he says, beyond that, this is not my responsibility. That itself is a very sad aspect. We, unfortunately, in 70 years, we misled the farmers. We only told him how to grow. We never told him how to earn. For 70 years, ignorance is on the street today. What is the role of agriculture universities? For them, when you say, what about financing? It is an issue of management. And with this should be taught in MBA colleges, not in agriculture universities. What can be more disgusting? That a commodity which is produced by 70% people, which is an asset class, even the scientists in agriculture universities have no clue how to value the asset. And the asset which they are teaching how to create the asset, for example, wheat or rice or maize or pulses or oils or whatever. They are creating assets in the field, but they don't know how to value it. They don't know how to do costing of it. They don't know how to plan better return out of it. So you are creating an asset without keeping market requirements in mind, means continue to produce wheat and rice, because that is the only thing we are teaching. Who will buy? We don't know. If nobody buys, go and shout at the government. Then in democracy, it is the moral authority of the government to take care of the citizens. And then you start with MSP and continue with MSP every year. And if you look at the statistics of last 4 years, when you started adding into cost of production into 50%, look at the surge in imports in India. We do not appreciate that we are part of a market. Politicians have a short-sighted view. For them, the country's life is next election. They don't think beyond. For them, it is their shelf life is next election. So they have to save that. What will happen next time? After that election, we will see when we will cross that bridge. As professionals, as professors, as managers, as researchers, should we behave like politicians? Our job is to understand that commodity and value creation opportunity and educate every participant in the value chain. That if you are selling a corn at 15 rupees, to convert that corn into cornflakes, I need a factory. These are the costing. Why it is important for us to educate them? Because if any one of them is also interested to come collectively and want to set up a cornflakes industry, they should do it. Why they should sell it to Kellogg's or XYZ company and wait for their money? And Kellogg will always pay only 20 rupees, not more than that. So unless farmers are educated that how to make money in commodity market, they will always remain sufferers. And I always say that in commodity space, there is a production belt, and where it is produced, it is not consumed there. And you will never get prices in the production area. So you have to go and connect to the consumption center. That may be, for example, 100 kilometers. Now to travel 100 kilometers, if the vegetable or any crop or any asset, take any agro commodity, is selling at 10 rupees a kg, and if that is selling to the consumer, and consumer is buying at 50 rupees, it means to travel 100 kilometers, the value addition goes up by, even in the same commodity, not by changing any processing. Just you are changing the time and location. And the value addition goes up by 100, or I will say from 5 to 50 rupees. Technically, at every 10 kilometers you travel, you will add up another 5 rupees. I'm taking a very simplistic view. Who will tell this to farmers? That when you are producing something in your farm and you want to sell from the farm, you will never make money. You have to go and connect to the farmers, to the consumers. Is there any education system in this country who is teaching this to farmers? Is there an agriculture university who is doing it? When it comes to derivatives market or futures market, how many farmers, forget about farmers, how many educated people understand? Even till date in Parliament of India, we debate that futures market is bad. Even parliamentarians say that this market is bad because they don't understand. So that's what I'm saying, that we should not blame common men on the street. You go and talk to the corporate world. I was handling corporate commodity trade. When I go to the chairman and to my CFO, I think let us do the hedging in the commodity market. We will have, cushioning on the market shocks. The response was, Vijay ji, diye to satta bazaar hai yaar, dur hi raho inse. If this is the level of literacy of CFOs and board of directors and chairmen of the company, what do you expect from a farmer? So my request is that only issue, if we really want to understand the changing face of India in economic world, I think next 5 years, across the board, students, teachers, faculty, get out of your routine jobs and just focus on common man's financial literacy. If you really want India to emerge. Otherwise, we can write n number of good paper, which is of no use to common man. We can continue to do n number of theories and expressions and trigonometry analysis or statistics and whatnot. Country will not gain out of it. Unless common man learns how to handle money, and my assumption is, and I always say that as my last statement, I always say that money is like a fire. If you don't know how to handle money properly, it will ruin you. That's why n number of NPS, all genius people, all highly qualified people created n number of NPS in this country. They all were highly educated people at very high positions, taking high salaries. What they gave this country? NPS. So don't say that literacy or illiteracy is only a common man's problem. At all levels, there are problems. And unless we educate people in this world and make a mission as a financial community that we have to educate people what is finance, how to handle money. Let's talk the language of money to common man openly and boldly. Instead of shying away, he is talking money. We are not in a socialist world. Human greed, human needs will remain. This is a human weakness. So why don't we address openly? Yes, you have to make money, and how to make money and how to handle money. Unless we accept this as an open forum, whether it is a commodity market, stock market, bond market, options, all these are tools. Provided I understand the language only, then I will understand the tools. So what I'm saying is we are discussing the tools, but we are not telling the language of the tools. Then can people appreciate this? No. So I will say, as professionals, we have a huge responsibility. And in the last 70 years, we failed in our duty. I think time to correct ourselves. Thank you very much.
Thank you, Mr. Sardana. I think you made very interesting points which I was not aware of. There is a huge amount of financial illiteracy in the economy, and there is a huge amount of market distortions. We need to actually look at, as we teach actually in most of the MBA's institute, it's perhaps important for us actually to check and recheck that commodity market should form a part of the actually course curricula, as you have rightly said. I think it's important for all of us that we need to give some more time to actually know about what is financial literacy, that the country is also not looking at. Neither country is making any much efforts actually. I found your entire speech is very interesting in the sense that you could take actually sides of anti-establishment. That's very unlikely what I have noticed actually in many business schools. Thank you so much. We are going to open up the floor, and especially for you when we look at the question answer sensor. My next panelist
You're welcome.
My next panelist is Dr. and Professor D.K. Malhotra. I believe he is based out of Philadelphia in US, and it's a very awkward time and obnoxious time actually to make him wake and listen to him live. I understand that we are going to lose most of his remarks, but he has apparently sent some PPT presentation which can be actually played right now so that we get a glimpse of what he's going to talk about. Can we have the PPT presentation, please?
Good afternoon, everybody, from a snowy and wintry Philadelphia. It is very cold here because of the winter storm that was here day before yesterday. Thank you for allowing me to present my remarks on the Indian financial system. My name is D.K. Malhotra. I'm a professor of finance at Thomas Jefferson University, which is in Philadelphia, Pennsylvania. Philadelphia is between New York and Washington, D.C. It is the birthplace of the United States. And here is my website where you can get more information regarding me and my research interests and things like that. Now, let's talk about the Indian economy just before COVID 2019. The growth of the Indian economy was already slowing down before COVID-19 outbreak really happened. I'm sure all of you are aware of it, that Indian economy was registering a slower growth throughout 2019. And Reserve Bank of India, the government blamed the Reserve Bank of India for this slower growth because they were keeping the interest rates too high for too long, and that was keeping the liquidity tight. And as a result, growth began to slow sharply long before COVID-19. So to jumpstart the economic growth, the Reserve Bank of India, it engaged in rate cuts 5 times since February 2019. Like about a year before the COVID outbreak, they engaged in rate cuts 5 times since February 2019, and they engaged in 135 basis points cut or 1.35% cut. And then comes in the COVID-19. The lockdown started in India sometime around March, and as the COVID-19 induced lockdown started, the Reserve Bank of India intervened through liquidity measures across three categories. So I'm referring to you to the International Monetary Fund website, where they have listed the response adopted by each government. They have listed by country-wise the response adopted by each government. So the response of the Indian government was, and the Reserve Bank of India was, three-pronged strategy, which was using the long-term repo operations, a cash reserve ratio cut of 100 basis points, and increase in marginal standing facility to 3% of the statutory liquidity ratio, now extended till March 2021, and open market operations, which basically include buying and selling of government securities simultaneously. What was the result of these three measures? They were able to introduce liquidity in the market to the tune of 5.9% of the gross domestic product through September. The response is not surprising given the lessons learned from the Great Depression of 1930s, given the lesson learned from the economic crisis of 2008-2009. Whenever the economic slowdown of this magnitude occurs, to prevent the economy going into the depression stage, the only option available is that you pump money in the economy, you inject liquidity in the economy, and that's what the government did. That's what the central bank started doing back in March of 2020. So what does the future hold? Here is what the future hold. Because there is too much money available in the economy, there is fear of inflation, but probably this will help in economic recovery. But at the same time, the stock market is getting dangerously overvalued because of cheap money available. Stock market continues to rise. A lot of people ask me that why is the stock market rising when the economy is not doing well? It's mainly because cheap money is available. So you can get the money and invest in the stock market. So stock market is getting overvalued, and that is getting to a dangerous level on that particular part. So the question is, should we continue with easy money and quantitative easing, or should we put brakes on liquidity? So obviously, if we put brakes, it can certainly hurt small businesses, it will hurt growth. And there is excessive liquidity in the market. If we don't pull the liquidity out of the market, it can cause inflation. So what should the Reserve Bank of India, or what will the Reserve Bank of India do? Certainly, they don't want to hurt economic growth, and at the same time, they don't want inflation to get out of control. The argument that I'm reading and the argument with which I agree is that probably Reserve Bank of India will allow the stock market to continue to rise. I mean, they want the stock market to be there at a level where it will build investor confidence in the economy and in the Indian recovery. You don't want the stock market to go down, because this can reinforce that Indian economy is not doing well. This can actually cause more of a bearish sentiment with regard to the Indian economy and Indian growth, and it will become a self-fulfilling prophecy, which will hurt the Indian economy more in the long term. So they are probably betting on this, that let the market rise, because this will build consumer confidence, this will build investor confidence in the Indian recovery. Now, at the same time, you don't want to scuttle growth, and you want to be more flexible. So RBI is adopting now a flexible inflation policy. They are not being rigid with regard to their inflation targets. RBI's typical inflation target range is 2% to 6%. And within the past 8 months, continuously, inflation has been slightly more than 6%. And they haven't taken any action on that particular part, because they believe that the economy does need support. Economy does need help for growth. So they are being flexible with regard to the inflation target. And going forward, that's going to be the key. That's going to be the mantra with the Indian policymakers, that flexibility so that we can adapt to the changing environment. So they will have to adopt a balanced approach to liquidity so that it doesn't hurt exports, that means the growth, and at the same time it keeps inflation manageable. That means they have to walk a very tight rope so that they can allow the rupee to go up in a phased manner over a period of time, so that inflation remains under control, and at the same time it doesn't hurt growth. Now, there is another incentive for the RBI to allow the rupee to appreciate, because with a stronger rupee, probably it can help you fight inflation. Because when your currency is strong, you need lesser units of your currency to buy goods and services. So it can actually help you fight inflation. So my bet is that you will see rupee rising in 2021. And there is influx of foreign money in the Indian economy because of the privatization deals being offered by the government, because of mergers and acquisitions. And government's emphasis going forward is on flexibility. Flexibility and adopt economic policies that make Indian economy more flexible to make it more resilient to economic shocks. So you are seeing those reforms taking place slowly. I mean, there are labor reforms happening. There are land reforms happening. There are agricultural reforms happening. I know that there are a lot of protests against the agricultural reform, but you're seeing those policy initiatives being taken, agricultural reforms happening in the Indian economy. You will see these kinds of reforms which provide flexibility to the policy makers so that we remain relevant in the post-pandemic world, so that economic shocks can be absorbed more easily with this flexibility. Certainly, there is no one policy that fits all the nations. What works for the US may not be appropriate for India. What works for China may not be appropriate for India. What works for South Korea or UK or European Union may not be appropriate for India. So India's response has to be India specific, and Reserve Bank of India and policymakers are adopting India specific responses so that India does remain relevant in the post-pandemic world. So going forward beyond this, what would happen in the Indian financial markets, where it is headed? I mean, I already mentioned that in 2021, expect rupee to appreciate a little bit in the market. RBI will have to allow the rupee to appreciate because it will help them fight inflation without hurting the growth to a major extent. You will see more adoption of digital currency. I mean, what the demonetization couldn't do it, probably this will do it. There will be more adoption of digital currencies. More important, you will see digitization of business models. During this pandemic, those companies have done very well where their customer was sensitive to digitization. They were already digitized sensitive. So you will come across more and more companies adopting or tweaking their business models towards digitization, because that will help them in growth, that will help them remain successful in the post-pandemic world. Even in the education sector, you will see that, like we have been teaching through Zoom and everything. So everybody thinks that when it is over, we'll all be back in the classroom. Yes and no, because this model of online teaching through Zoom is not going to go away. You may see changes in higher education delivery also on that particular part. You will see changes in the workplace also on that particular part. And you will come across new types of bonds that can help the central bank take away some excess liquidity from the financial system without hurting the economy. If you need any clarity, if you have any questions, any comments, feel free to email me at davinder.malhotra@jefferson.edu. Again, my website is there, sites.philu.edu/Malhotra-D. It'll give you information about me and as to what my research interests are or what I have been doing.
Okay. Thank you, Thank you, Dr. D.K. Malhotra, for sending us that PPT presence. You made a lot of sense in saying that macroeconomic policy objectives are extremely important in the post-COVID-19 situation to create a pent-up demand, for which you need to have a low interest rates and you need to also have fiscal stimulus. Now, fiscal stimulus in India has been given, but we didn't have much of credit stimulus actually, which is very important at the same time, because people may not be actually availing or have an access actually to fiscal stimulus, but credit stimulus at a particular rate, maybe lower than even current repo rates, should be actually advisable to do that. When we look at actually our macroeconomics policy objectives to be balanced, it sometimes becomes very difficult even for the policymakers and the bureaucracy to do it. Because once you would like to contain actually inflation, maybe you give away your output. So there is always a trade-off that we notice between inflation and output. Having said that, you made certain interesting points about talking about the three themes that broadly Indian government and RBI can actually take up to do the results that is required actually for the economic growth to be sustained. Thank you so much. It's very unfortunate that we couldn't speak to you live, but having sent your PPT, it made a lot of sense. Thank you for your contribution. My next panelist is Mr. Naveen Gupta, a renowned financial banker and spent a lot of time in insurance and other fields in SDFC and ICICI. I have a great interest in looking at actually systemic investment plans, so maybe sometime in future I can get in touch with you. Having said that, you are going to largely speak on insurance. I understand that you have made already a lot of remark in your email when you sent it to us that why and how insurance is currently having low penetration in Indian market and needs to be pepped up actually through diversification of products and prices. Thank you so much for joining. Over to you, Mr. Naveen Gupta.
Thank you, and good afternoon to all the. Can you hear me, sir?
Yes, thank you.
Okay, thank you so much. So, good afternoon to all the students, Professor Gupta, Dr. Varshney, all the fellow panelists, and all the esteemed dignitaries. So, there are a lot of heavy lifting which is being done by Mrs. Rosemary, which is Sardana on derivatives and markets and formalizations, and lot of discussions by Professor Malhotra about banking. So, Professor Kango, my main discussion will be on consumer and technology, not as much as on insurance, basically. I'm a thorough retail banker from last 20 years, and it's been a wonderful journey with HDFC Bank and ICICI Bank both. And insurance is one part of my portfolio. It's about consumer banking. So for the students, my area of interest to speak to you will be more about consumers, their behavior, and the technological change which is happening in banking and what is actually going on. So let me just dwell a little bit deeper about what are the big macro changes. Normally, whenever we talk about banking, we talk about a branch, a cash counter, interest rates, bad loans. I think let's sketch out to again. And from last one decade, if we talk about banking, we need to know more about what is API integration, what is digital banking, what is virtual banking, what are financial aggregators, what is JAM, what not actually. So a lot of lexicons are changing. So let's understand what are those lexicons basically. So what are the, first to start with, what are the big macro trends which we are seeing? And what I'm talking about is what we are doing in our bank, and being one of the largest private sector bank, we do a lot of such research. So first is about what Professor Malhotra was also talking about, is financialization and digitalization. So what are the financialization? After demonetization, after GST regime change, lot of way we are changing things, lot of way we are investing, lot of way our Indians are saving is changing. So as per the last report, 30 crore Jan Dhan accounts were opened, and we have more than 1.25 lakh crore lying there. I think this is the biggest scheme government of India has launched anywhere in the world actually. The second point is, what about the affluence? Though we are talking about farmer agitations, we are talking about commodity prices, but one definite trend which we are seeing is that there is widespread affluence and debt-driven consumption, which is we are seeing as a bank. So if we talk about last decade, 2016-17, there were 8% affluence customers for us. And now what we are seeing is 2025, we will have almost 16% as Indians. And what is it fueled by? It is fueled by a lot of retail debt, which we are taking now, which we were very averse to as Indians. Third is that a lot of Indians are making international footprints. And we are seeing that not only remittances, trades, merchant acquisitions outside, we are seeing a lot of interest by Indians buying properties outside, a lot of LRS kind of remittances happening, and a lot of Indians from outside sending almost $80-90 billion every year, and which is one of the largest. But the most important change which we are seeing, and which Professor Malhotra was also talking about, and another panelist was talking about, is increase in digital footprints. So almost 80-90% of the transactions, almost in retail banking, almost 50% of the transactions in MSME are now happening through one or the other digital channels. And there are a lot of research, a lot of fintech, a lot of banks which are investing huge amount of money. Now, when we were seeing all these macroeconomic trends, we thought that what should be the consumer behavior, or what are the consumer behavior which are really affecting this. So there are 6 clear-cut trends which we have seen. The trend first is how customer control the relationship. So there is huge upsurge in OTT platforms, digital payments, e-commerce. It is lending to customers controlling the transactions and relationships. Point number 2, we are seeing that the direct equity flow is at all-time high. So we have different views about whether the money should move into mutual fund, whether money should move into equities or insurance sector or fixed deposit. But ultimately, when we are saving a lot of money, it is not only moving into fixed deposits, it is moving into direct equity, it is moving into mutual funds, it is moving to HNI are investing in global stocks directly. There are multiple things which are happening. The third point, health and wellness spends are soaring. So customers after the pandemic, I think it has get a leg up. People are rushing to buy medical plans. They know that what organizations normally give 4 lakhs, 5 lakhs, 10 lakhs. It is not sufficient for them to cover their medical expenses. As affluence is increasing, customers are more conscious about purchasing life plans for their near and dear ones. The fourth trend, we are seeing more DIY solutions, do it yourself. So customers want to do the research themselves through multiple channels, and they want that research should be available at a single platform. They are doing a lot of, if you talk about consumer, they are buying a lot of dishwashers, a lot of vacuum cleaners, a lot of robots, a lot of cooking waste, and it is affecting the banking also. The fifth point is, obviously, because of the pandemic, how are the work changing, how are the life patterns change. We can always discuss whether migration, reverse migration, but a lot of activities which are happening. And sixth is on-demand proximity services. What we say is home deliveries, everybody should come to home to deliver saloon services, or a lot of these things. So there are 6 clear trends which we are observing as a bank, as an organization. So what should be our response? What should be our response for 2025? What should be our response to 2030? So I have jotted down it in 3 clear-cut segments. One is run, second is evolve, and third is reimagine. So what we are talking about run, I'll use some terminologies which are internal to us, but I'll try to restrict it. So what is run? It's reliable, modern, and secure platforms. You are seeing instant banking, you are seeing mobile banking, you are seeing a lot of adaptations of internet banking. People are getting more secure, more confirmed about security of these aspects. Yeah, we might have divergent views, but there are more customers who are using mobile banking. There are more customers who are using internet banking, and this is changing. The second is how we are using technology to deliver seamless service and improve process efficiencies. So why we have said it run? Because these are existing solutions. These are existing things which is supposed to be happening in an organization, in a banking organization, and how to improve. So now, if the customer is evolving, the customer is demanding, how as an organization I should involve? There are 3 parts to it. First is the customer is asking it right now. I want it right now. I want it free of any charges, and I want the best. So what is the organization's response? Organization's response is based on customers' understanding, based on a lot of activity which the government of India has done, including digitization, including Jan Dhan accounts, including PAN cards, including Aadhaar cards. We are being able to integrate them, and as an organization, banks are now giving small ticket personal loans, auto loans, instant fixed deposits, instant credit cards, instant insurances. So lots of instant things are happening. What is it? Our soaps or our shampoos, maybe 20 years back, is happening to banking now. Second is hyper-personalization. So a lot of offers we are being able to curate to the customers because of availability of technology, because of availability of multiple data, and integration of all the data because of these capabilities banks are developing. And third is round-the-clock processing. Now, for example, since last month, NEFT and RTGS can be done 24/7. The RBI and government has enabled it. So it's a very, very progressive legislation. So you can do paperless processing, you can do a lot of anytime banking, you can say 24 by banking, 24 by 7 banking. But ultimately, because of technology, because of the consumer demand, the banks are available 24 by 7. And third part is about digital payments, which I've already touched upon. Your API, your UPI, your Bharat Pay, what it is leading to. So one of our panelists was talking about payments for 10 rupees, 15 rupees, 20 rupees. Yes, exactly. That is what government is trying, and that is what banks are pushing through. A 10 rupees also can be paid by Bharat Pay. It can be paid by multiple bank solutions. It can be paid by Paytm, and there are no charge to the consumer. So what it is leading to? It is leading to a lot of small grocers, lot of small shopkeepers accepting these payments without any gifts. And it is growing very, very fast. Almost 60% of the payments are expected to be through them. I'm talking about small payments, which is at around 17, 18% right now. The third, which is the most important part, which I'm talking about, is reimagine. If everything else is changing, everything around is changing, consumers are changing, legislations are changing, ease of doing business is changing, technology is enabling. So how we are changing it? So we have now, say for work from home, we have started something called face recognition. So our employees can recognize their face and they can work from home instead of saying that, yeah, sir, we are present. We are doing biometric authentications. We are doing chat box and voice boxes. We are doing a lot of artificial intelligence data processing to understand 360 degree of the customer and give them personalized solutions. We are doing a lot of robotic processing. For example, my currency chest. Currency chest is where the most of the cash for the bank is kept. Now, robots are checking those cash for originality. They are sorting it out and they are bundling it also. I'll give you two examples wherein, as an organization, we have really used reimagine the technology and how we have been able to do it to make the point clear. First, so we were finding that in India, almost 85%, 88% of the farmers have small land holdings. And those land holdings are not marked and they are not clear and they are not digitized. So we have tied up and we are the first bank to use satellite technology to understand the exact land holding of the farmer, exact geotagging that land holding, which is helping us in disbursement of the loans and as well as our collection efforts. This is one use of technology which is very, very advanced. The second is when we used to do branch, we used to say that let's open a branch on the main road, let's open a branch on the main markets or in a big commercial area. Now, what is the newer way? How we are using the technology? We are saying that even say, for example, in Delhi, it's a big market. Do we have to open branches on every high street or every main market? No. Because of the use of the technology, because of use of the data which is available publicly, we have been able to clearly identify through geospatial micro market analysis, to risk calibrated opportunity scoring, that where should be our next touch point for the customer. Because in India, still, even if we are talking about technology, we still need customer's touch point. So instead of saying that Delhi is a big market or Gurgaon is a big market, through use of technology, through use of information, through use of layering, we have been able to actually pinpoint where we are supposed to have our markers, where we are supposed to have our market presence, and where our priority is for 2025 or 2030. So thank you so much for calling us here. We are open to questions, sir.
Yeah, thank you, Mr. Navin. I think you provided a wide view about how you can make actually customers really king in the financial sector, because you are trying to say that customer is very important and it's a priority area for us to make digitally how customers can become actually more productive and active in the market. Thank you so much, Mr. Navin. It's wonderful to have met you. Our next panelist is Professor Madhuvij. Madhuvij is very well known to this institution, and I have learned a lot from her in terms of discussion. I don't have to give any such wide introduction to her. She needs perhaps no introduction, but As a matter of fact, others may not be knowing so much. Professor Madhavis is currently Professor of Finance at FMS, Delhi University, has done a lot of work in relation to financial sector and regulations. I have great pleasure in inviting her to speak today here. Thank you for agreeing to speak on this occasion. Over to you, Dr. Madhavis.
Good afternoon and a very, very warm welcome to all my esteemed panelists here. Let me start by saying that it has been a completely enriching experience to hear to the panelists. Each one of them gave a broad coverage, different dimension, helps us to understand a lot more about the Indian capital market and the financial market. Thanks to Shastriji, Professor Sharma, Dr. Pankaj, Dr. Praveen Gupta for giving us an opportunity to express our views. And, what I'm going to do is I'm going to mainly handle the first question, which was posed by Dr. Anand. Is there a foolproof system to ensure that another global crisis does not happen? And I think a lot of thought has gone into it. And I think sometimes it could be our worst fears. How do you tackle another crisis? And we hope that we do not face another global crisis. My interaction here would be related to an important set of institutions, the credit rating institutions, who had an important role to play during the global financial crisis. Were they to blame? Because if we have gone through, in fact, I would say the last 10 years, that has been very, very eventful for the credit rating agencies, and they have received both a flag and a lot of positivity also from a lot of regulators, which has also helped to relook at their role. In fact, this whole phrase which we were using after the global financial crisis, reposition, reorient, being reactive, being proactive, which were the two terms which were used for the credit rating agencies, that they were very reactive, whereas they should have been proactive. Now, I'm going to take a few leads from this part here. But before I begin, a very, very little background on the global financial crisis and how it has probably, helped us to move ahead. So it was the global financial crisis, how, this whole thing about ratings given by the credit rating agencies, and we are talking of the international credit rating agencies here, Standard & Poor and Moody's, and how there were a lot of, concerns about the ratings they gave to a lot of institutions, and specifically to Lehman Brothers, who even 5 days or even a few days before the crisis had a AAA rating. Now, the whole issue, therefore, is what can be done or what should be done about the role of credit rating agencies. Now, if we look at, the whole reason for the formation of the credit rating agencies, whether it's in India, you talk of an ICRA Care or, CRISIL, or you talk of a Standard & Poor and Moody's, the fact is that all the credit rating agencies do not have as stringent a role as the auditors. And theirs is, more a suggestive role. So it's like we are giving a rating, take it or leave it at your own risk. So that's why we say they are only giving an opinion and accountability is not there. So if we go back to the Enron crisis, I mean, we all know what happened to the auditors and Arthur Andersen. But after the global financial crisis, what happens to the credit rating agencies? There's a complete silence. However, not for long, because what has happened, through the efforts of the Securities and Exchange Commission, They have fined both Moody's and Standard & Poor for the toxic and fraudulent rating which was given by them. So what does this mean? We are moving towards accountability of the credit rating institutions. And I think once there is a little more accountability, that takes care of the processes. Honestly, I'm only talking of literature here, that after the global financial crisis, a lot of literature, when one read the summation and the conclusion or whatever we would like to say here, was who's to blame for the credit rating, who's to blame for the global financial crisis? It's the credit rating institutions. Now, taking a little cue from this, how do we move away from the whole blame game of the credit rating agencies? Now, it is in this context that, one could offer, obviously in my capacity, offering, any suggestions, or, I'm only offering my thoughts, what one could feel could be a little direction, which a part of it has been also taken care by SEBI, or if I don't even say SEBI, maybe a good term would be the regulators. So what could the regulators do? In what direction could they move forward so that, this kind of an event is not witnessed? That is one. But if we move forward from there, we have had a COVID, we have had a pandemic, and, a slight or maybe a parallel between the two. The global financial crisis was a financial crisis, whereas the pandemic is both humanitarian and financial. So our solution, or, how we approach this problem definitely cannot be the same, because once there is a human element to it, the kind of concerns and the caution which the regulators or the leaders or the public at large needs to adopt would be a lot more different. I do find that now the ESG, the three words which have become very important, which are standing for environmental, social, and governance, they have started to play an important role in our life. So whether it's organizations or whether it's the credit rating agencies, I think they need to focus a lot on, these factors. And this also reminds me, of the fact that when we were talking about the global financial crisis, the basic reason or an important cause was the high modeling factor, wherein, you talk of a quantitative model. And the shift which we are focusing now, I would say not really after COVID, in fact, it was after, let's say, a few years, was the qualitative dimension. The qualitative dimension is what even I would like to focus here, wherein, you need to look a lot beyond the quantitative modeling. So whether you talk of social factors or you talk of how would companies adjust after the COVID in terms of, even, let's say, a model which takes care of the climatic changes. Now, all these are important dimensions which we need to take into account in the ESG part of it. So governance, we all know, how important it has become much earlier, even much before the global financial crisis. The second issue which I would like to emphasize here is the increased focus on risk management. The whole, I would say, the landscape of risk has changed. And if I were to use a word, traditional risk and enterprise risk management, Now, these two terms have become really relevant, and you find that they are constantly being used. In fact, I was listening to a discussion on Companies Act 2013, and it was very interestingly mentioned by someone that if the Companies Act 1956 mentioned risk, let's say, 10 times, the Companies Act 2013 mentioned it as 10x, which means 10 times of whatever number the risk was being emphasized. The point is, in the new environment, in the changed environment, risk is becoming important. So the last few years, all company boards, they are mandatory. It's mandatory to have a risk management committee. It's mandatory to put up your risk management systems online, on the net. And, this whole process of internal controls, financial reporting has become very, very important. To just maybe talk a little more in detail about the enterprise risk management, the traditional risk management talks about looking at risk in silos. So if you have a department, let's say a production, an HR, a marketing, a finance, each one of them will look at risk from their perspective. It's realized it's not right. You need to take an integrated view on risk management. And that is what the enterprise risk management emphasizes. In fact, if I borrow from the COSO framework, which is again not very new, it's about 2004 framework, which talks about risk management in terms of strategic, in terms of operational, in terms of compliance, and in terms of governance. So it gives us an integrated view wherein it says, do not look at risk in silos, but, reorient yourself, re-energize to the organizations to, be looking at risk, shift it from simply a survival motive or a survival tactics to an aggressive tactics. Okay, so this is one, focus. I would want. In fact, it is being emphasized. So I'm not saying it's not there, but maybe a little more focus, a little more aggressively is what one could emphasize. And the last part here, which is also becoming a lot more relevant, is I could raise this issue by asking a question. Why do financial statements, or why are financial statements so relevant for industrial companies, for normal organizations, but not for digital companies? So if you talk about a digital company, so you talk about an Uber, or you talk about an Amazon, or you talk, an e-commerce company, or you talk about a Microsoft, you will find that all these organizations, in spite of huge losses, when they have gone in for an IPO, at least Uber, I remember, I think it was 2016, they have had a positive feedback from the market. So for these companies, in spite of showing losses, if the market is valuing them feasibly, then somewhere we need to relook at our focus in terms of how we look at the balance sheet, how we analyze the balance sheet and the profit and loss account. So what I'm meaning here are the financial statements, What I would like to, talk about here is what is the reason for investors looking at or reacting, I would say, negatively to a normal company's financial statement if they find losses, but completely disregard losses for digital firms. And one of the reasons for this could be that, the whole process of evaluating digital firms is a little different. They would have absolutely no inventory. So if you look at an e-commerce company like an Amazon, how would a traditional credit rating institution evaluate them? Because they have no inventory. So what could be the assets of a digital company? The assets could be, let's say, in terms of a brand, in terms of research and development, in terms of their clients, in terms of their customers, a social orientation, the softwares which you have, and maybe one could list a lot more. But, intangible assets, and I heard Professor Sharma was also talking about that, in his speech. Now, intangible investments or assets is, I think, something which needs to be highlighted. Because when you talk of physical assets, they're going to deteriorate. They're going to, the value reduces with time, not really deteriorate. There's a reduction in their value. But when you talk of intangible assets, their value increases with use. Their value, I would say, goes up with time. Now, the fact of the matter is that we've recently revised our Companies Act. So we're not going to re-revise it. But yes, there has to be a mechanism for looking at the financial statements for digital companies. So I would say that these were some of the issues which I thought could be highlighted. To answer the question, is there a foolproof system to ensure that there is no global crisis? I would say it's a very difficult question which Anil has posed to all of us, but it will be our endeavor, it would be our belief, and probably we could pray also here that there is no other, we don't face a global financial crisis, though I would say the present scenario we are living in a pandemic, it's a little more aggravated and it's more worse than the global financial crisis also. So with that, let me close my thoughts here because I'm looking at the time also. And once again, congratulations to everybody at Lal Bahadur Shastri for organizing, this conference. And thank you to all my co-panelists also. Thank you.
Thank you, Dr. Madhubiz. It was wonderful to have heard you. You made very useful comments about talking about that the world perhaps is not at the moment equipped not to witness actually another global financial crisis. You also spoke about that how risk needs to be actually studied and risk needs to be actually captured. You also mentioned about ESG, which is extremely important in the current scenario. Actually, not many institutions are there to actually provide such kind of information, which should become actually part and parcel for every economic or financial decision to be taken. Thank you all the panelists. It has been a great learning experience personally for me. Right now, you open the floor. There are a few questions are going to come from the students because they are deeply interested to raise certain questions. I request the students first to raise the questions.
Good afternoon, esteemed panel members. Now, with your due permission, I, Shelly Sharma, second year student of PGDM Finance, along with my colleague Karthik Agarwal, would like to ask some of the questions that have actually popped up in the chat window from the students. So, the first question that they are asking is that if we see at the long year, 10-year yields, they are actually lower by 50 to 60 basis points. However, the inflation is higher by 200 basis points. So what are your views on this?
Whom did he ask? Whom did she ask the question? Any panelist or anybody can answer? Anyone in the panel can answer actually the questions posed by her.
Can we hear the question once again, please?
just tell her to.
Yes, sure, ma'am. So the question that the students are asking is, if we look at long and 10-year yields, they are actually 50 to 60 basis points lower than the start of the year. And whereas if we look at inflation, it is higher by 200 basis points. So what are your opinions on this?
I mean, I would only say that a lot of what you're talking about, long-term yields and about the inflation, a lot of them are market-driven factors, and a lot of them are environmentally driven factors also. So how the market is perceiving, about the yield, and then I believe there would be, intervention by the regulatory authorities also in terms of the 10-year yields. So maybe the other panelists could respond a little more because.
Hi. So if you see that there are multiple correlations in economics and banking about interest rate, inflation, and growth. So if you see in India, what we are trying to make is we are trying to make a case wherein the interest rates are low, the inflation is also not very high, which is yield range bound, and we should be able to generate a lot of capital to do investments. So in that scenario wherein you see any rate actually, you are talking about Government of India yield, why the lower yields are, but you see any rate, you see fixed deposit rate, you see bond rate, you see asset rates at the rate at which we are lending. All had come down, and this is showing in the way economy is moving. I'll give you certain statistics to make you guys understand. So there is something called CD ratio, credit to deposit ratio. That means how much credit in the systems are and how much deposits are. And I'm talking about specifically for banking, but that is what I understand more. So it's about 72%. And if you are talking about 2 years back, it was 76%. So for an economy which is almost $2 trillion, this 4% makes a huge difference. And if we see that what is the kind of growth we are seeing in deposits and what is this kind of growth we are seeing in advances. So one of the panelists was talking about availability of low availability of loans for MSME or other sectors. If I see that credit growth is growing, but credit is growing by only 5%, whereas deposits are growing by 10%. What it means is the banking system has a lot of liquidity available, but the demand for credit is not forthcoming. The demand is mostly coming from consumer finances. What we talk about personal loan, what we talk about auto loan or mortgages or loan against securities and all. But what about that factory which will need 5,000 crore or 10,000 crore or 20,000 crore funding, which is not forthcoming because of the factors. So the focus remains this year, next year, next year on keeping the interest rate low, keeping the inflation range bound, so that the funds are available to the corporates at the right price point. That's the answer.
Thank you, sir.
I hope I have been able to answer it.
Yes, sir. Thank you, sir, for such an enriching answer. Sir, there's another question from my fellow classmate. What are your views on the robustness of the Indian financial system to meet the present challenge of boosting Indian economy along with maintaining its asset quality?
Mr. Nabin Gupta, can you answer
Professor
this?
Vij, you want to answer it? You want me to answer it? Okay. So see, when we are talking about robustness, it's not the financial market banking is one of the most important pillar for financial markets. And then we have equity, commodities, the derivative and multiple channels. But if we talk about the way we are moving towards consolidation in PSU sector, the way we are moving towards ensuring that even cooperative sectors, cooperative banks are coming to regulation with RBI, the way we are trying to do some of the things, including we have talked about Yes Bank merger, SBI taking over most of the operations of Yes Bank or recent LVB. The regulator, the government, what they are trying to do is they are trying to consolidate. They are trying to make some big institutions which can take higher risk because obviously banking as such is a highly leveraged entities. So what I mean by leveraging is that if I have 10 rupees as a bank, I can lend easily 10 times to 15 times out of that money, which is easier. So 100 rupees I have of my own, I can lend 1000 rupees or 1500 rupees. So what government is saying is that we need bigger banks. We need banks which can give big capital to corporates. Say, for example, we want to have an industry which will give us chips. We are likely to import $500 billion of chips and electronics. But why that factory is not being able to come? Apart from other reasons, the single most financial reason is initial plan was it required $5 billion to set up fabrication units, fab units, which is famously called. Now, who will give that $5 billion? In India, even State Bank of India can't give it. So when we are talking about financial stability, one is the size of the organizations, that is banking, the regulations, which they are trying to control through CRR, SLR, and repo rates. And third is about keeping economy for the future. What I mean by that is that there are a lot of technology enablement which is happening in banking, so that the real-time transactions, the transactions can be monitored real time. So that will give you a lot of pop-ups, lot of insight into transactions and monitoring of the transactions. The three, if we combine all these three, I think even in 2008, our banking has come out well. Even in 2020, post-COVID, it is likely to perform better as compared to some of the bigger economies. And I think the way we are regulating it, the way we are structuring it, we are ready for the future.
Thank you, sir.
Ma'am, you're on mute.
Okay, is that okay now?
Yes, ma'am, you're audible.
So just to add on to what has been said, completely with his views. So, what I remember Rosemary was mentioning about securitization. So the important thing is that for a lot of years after the global financial crisis, we discarded securitization. But the point is the tool is good. It's how it has been used. So, and the fact that our entire Indian banking system is moving towards international benchmarks. So I think if we look at these in terms of whether it's the Basel norms or whether it's, other liquidity requirements, I think competition, market forces, survival of the fittest, we still have to see the impact of the bank mergers. And one of the reasons for the mergers is the strong, stringent requirements of the Basel norms here. So I think with all these factors, I'm sure the robustness, the asset quality would improve. And I'm sure we would know about, the proposal to set up a bad bank also. So even that would take away a lot of, bad loans, bad assets from the balance sheet of companies and make it a little more clean. So I think these could be some of the measures, but definitely we need to wait and watch and see how things evolve and pan out after the crisis.
Thank you so much, ma'am. I would now request Professor Kanungo to please go ahead with his questions.
Okay, my question is directly to Rosemary. Now whatever you spoke, that's okay, but I have another question which is concerning about predictable pricing that you look at when you are dealing with actually commodity markets. In the event of this farmers' agitation, how we are going to look at actually predictable pricing in relation to the commodity price markets?
See, it would be unreasonable for us to believe that there won't be any volatility in the market. The prices are going to go exactly in the way in which we are predicting it to go. That is not going to happen. What I was at least trying to tell you is, let them lock in the price at the time of sowing itself. That we should be enabling, because at that time, for a farmer, if I'm a farmer, I know the cost of my cultivation, right? So I would try to lock on to a price at which it is easy for me to sell that product. So I'm basically locking in my margin. So the attempt should not be to find out that super profit maximizing price, but the one which would be covering my cost of production. And there should be a facility for me to lock in my prices at the time of sowing itself. So once that pricing uncertainty is taken out of my head, then I can focus on other improvisation of agriculture and things like that. And if I have a plot of land, the benefit of futures market is that, if I have a plot of land, then I could sow a mustard or I could use it for some other crop. So I will look at the futures prices and I will decide, okay, which of these prices are going to be more beneficial for me. So at that price, I would lock in and then I would start cultivating that. So I need not have to now worry about what is the price, I am going to get at the time of harvest. So this is the simple principle that we have to implement in the, farm sector.
Okay, thank you.
Pricing certainly.
Sorry, yeah.
Yes, we will have, but we will not be able to contain price volatility or anything like that. That will keep on happening.
That's right. Thank you so much. I have a question for Mr. Sardana. Your comments were very interesting. Therefore, in the event of this farmers' agitation, what are the policy, formulations that the policymakers should look at actually? And what is your special message, if I say in a lighter mode, to give it to the policymakers?
See, it is, first of all, thank you very much for this important issue which you have raised. I think we all are at very serious, I don't know about financial market, but at least for agriculture market, I can say very openly, we are at crossroads. If we take it in a right direction, there will be huge wealth creation in rural India. If we mess it up, there's going to be a lot of unrest in rural India. There's not going to be any midway. Now, in this process, we have to look at is how the whole ecosystem is working in India and where are the gaps. And then we all can derive what are the possible messages for policymakers. And policymakers, I will not give too much emphasis for a simple reason, because policymakers can always give you a broader contour. But the problem comes up is the managers, those who manage the institutions. They look at their convenience, not at the national priority. And that is a sad part of it. A classic example is universities. If you say why it is so, let me give you a very simple example. We have almost 50, 60 agriculture universities in this country. Every university has economics department. What was their contribution to agriculture? Except writing some paper which nobody reads. Or we have extension department, how much they understand about agriculture markets. They never go to market, they feel that simply teaching them how to make leaflet is extension activity. My problem in the whole system is that there is a serious disconnect between a market and the knowledge sources of economy, that is universities.
Okay.
Professors seriously feel that talking money in class is a bad thing. We have to remain socialist. We have to groom only the mind. Whether that mind is of use to economy or not, we don't know. And those who find their way, they will only look for jobs, and obviously, rightly. And that's what I say, that simply all IIMs and IITs are technically becoming a placement agency. You get a good degree and a good job. What is the contribution back to society? That becomes an ideological issue, which is not a point for discussion in society. So that is a challenge today. Now, to address this issue, what we have to do? Agriculture is a reality of this country. We know what are the agroclimatic conditions, what is the reality in the market, what is the country's population, how much food we need. What India eats is well documented. In number of surveys are there, whether you take it NSSO survey, RBI survey, Ministry of, any number of surveys you take it. We all know what country needs. Now we also know what bankers are doing. They are giving credit, and which is a dangerous trend. When the demand for consumer loan is increasing and corporate loan is not increasing, I will be extremely worried down the line 5 years for the bankers, because last time when I was in UK during Christmas time, every news channel was playing, or in various channels which I was flipping in the night because of watching them, okay, what people talk in news channels in those countries. They were telling that everyone is consuming by using credit card, but they know how to pay back. There were people, those who did purchasing in last Christmas, they were not able to pay back even this Christmas. And everyone in the country was under loan book. And they had no source of income, many of them. Are we looking for that society in a country where there is no social security? They have social security, so they can survive. At least they will get something to eat. If we are ennobling that Western model in our credit card business and everybody should live on credit, I am heading for another disaster. Now one has to look at what farmer is looking at. Yes, farmer is looking at market. He is saying, I have an asset called land. But what to grow in that land? Madam Rosemary has given a very interesting observation. Okay, you can do one thing. You can always grow mustard in the same place where wheat is grown. But point is, farmer says, मैंने तो आज तक कभी mustard उगाया नहीं. So you are saying there is a good price, but somebody should guide me how to grow mustard. And that is where the role of agriculture university comes in. But are agriculture universities geared up to educate farmers? Do we have mechanism to gear up the farmers? And that is what I'm trying to say, is that policymakers have to relook into it. When I say the rebooting the whole system, that we created many institutions in the system with 60 years old mindset. What has changed? Mandate of institutions have not changed. And this is the biggest challenge. We are reviewing the policies in this country, but we are not reviewing the mandate of institutions in this country. What was the mandate of Delhi University 50 years ago and what is the mandate of Delhi University today? Are they relevant? I don't know. What is the mandate of agriculture universities? Are they relevant today? I don't know. Point here comes up is that we have only looked at the relevance in a given context to suit the convenience of the leader of the institution. जो वाइस चांसलर कहेगा वो सब ठीक है, जो डायरेक्टर कहेगा वो सब ठीक है, नेशनल प्रायोरिटी से उसको कोई लेना देना नहीं. Same thing in ministries. When the secretary changes, the direction and the priority of ministry changes. What is the national priority? Nobody knows. Boss ने बोला है तो ये करने का. This is the way in advocism in this country is running, and that is why year after year, sector by sector, we are facing problems emerging. So my request is that to the policy maker, let us have a national plan. What is the national food security plan? What are our priorities? Which area should produce how much? How much raw material should go for industrial application? How much we are targeting export and which is the quality norm for the export? How many universities are aware? We talk about export quality, but how many professor knows what is the export quality requirements? Nobody knows. So my point is that we all are running this country on an ad hocism. Unless you have a plan, and then plan is disintegrated into unit operations, and institutions are made in charge to perform as per that requirement, whether they are universities, whether they are banks, whether they are other NGOs, irrespective of that, this country will continue to go into too many directions. We will continue to waste our time and money, and we will not get the results. So we need a national plan, which is missing.
Thank you, Mr. Sardana. I think there are n number of questions and endless questions. We can't possibly take all of them. I'm completely running out of time, I believe. I must thank all the panelists for providing very valuable suggestions and providing some amount of solutions which were not earlier existing. I must thank Mrs. Rosemary Abraham. I must thank also Mr. Bijay Sardana and our obligation to Dr. D.K. Malhotra. And I must thank also Mr. Naveen Gupta. And it's a pleasure to have heard Dr. Madhuvij. Thank you so much. Thank you for joining. And it's a great pleasure to have you once again.
Thank you.
Thank you.
Thank you, everyone, for such an insightful discussion. The floor is, I would now like to request Professor Anil Kanungo to felicitate Mrs. Ibrahim with a memento. Sir, I would now request you to please felicitate Mr. Sardana with a memento. I would now request you to please felicitate Professor Malhotra with a memento. Sir, I would request you to kindly felicitate Mr. Gupta with a memento. I would now request you to kindly felicitate Professor Wij with a memento. Thank you so much, everyone, for being here with us today. Listening to such great minds has been nothing but enriching and enlightening. And on this note, we have finally come to an end of our panel discussion session. I would now like to request Mr. Yash Khanna, President, Management Grid, LBSIM, Delhi, to deliver the vote of thanks.
So, good afternoon, one and all present here. I, Yash Khanna, President, Management Grid, LBSIM, on behalf of the entire fraternity of Lal Bahadur Shastri Institute of Management, would like to offer our sincere thanks to our esteemed panelists, Mrs. Rosemary Abraham, Mr. Vijay Sardana, Professor D.K. Malhotra, Mr. Naveen Gupta, Professor Madhu Vij, Professor Anil Kanungo, for taking out their valuable time for this year's National Finance Conference. This conference would not have been successful without the constant support of our Director Sir Praveen Gupta, Dr. G.L. Sharma, Dr. Anuj Verma, Dr. Pankaj Vashne, Dr. Gautam Negi, Dr. Shweta Agarwal, Dr. Nidhi Malhotra, Dr. Anil Kanungo, and all the faculties in charge of the conference. I would also like to thank the organizing committee of the conference for making sure that everything proceeded smoothly. Lastly, I would like to thank the audience for patiently listening throughout the session, for being a part of this conference. And we hope to see you all for the next year's conference. Thank you, everyone. Thank you.
Thank you, Yash. We again profoundly thank all the dignitaries for their gracious presence in today's conference and all the students for being such a great audience. Moving further, our paper presentation session will begin at 2:45 p.m. post a short break. Thank you all once again for joining in and being such a great audience. Thank you.